Sorry, quick question. This is Brandon Stanger. I logged in, but I'm trying to get in with my computer so I can get my video to work. When I put in the meeting ID, the Presidio, it's not pulling up through like the Zoom app. Did anybody else have that problem?
So you clicked on the Presidio raisingthebar.com and
yeah,
then
it works. It works, but then when I try to log in through the app on my computer, it asks for meeting ID, and then when I put that in there, it says this group or this thing doesn't exist.
Casey or Chelsea, are you available?
Try and download your Zoom again. I had to.
Okay.
And make sure the meeting ID number is 801-251-6683. Make sure that's correct.
Okay, that's different. I didn't know that
one
number.
more time.
Yes, 801-251-6683. That is the meeting ID number. And then if it asks for the password is 1234567
Okay, I will also put that in the chat.
Okay, perfect.
Thank you.
Okay, this is David Kenny. I'm going to start out. Can everybody see the PowerPoint presentation?
No.
No? All right, so I got to figure out how to. Okay, so I click on share screen. Did that work now?
There we go. Yes.
Okay, excellent. So today we're going to talk about seller financing. A little bit of background. I started real estate in 1981. So as you can tell, I'm a really old guy. And in 1981, interest rates were 18%. And obviously at that time, we didn't run our buyers down to the local mortgage company and get them pre-qualified for a loan. We just didn't do loans, period. Nobody could afford interest rates at that rate, at that high. And so all of the transactions we were doing were seller financing transactions. And so that's how I cut my teeth in real estate, is by learning how to do seller financing. And I've kept those skills throughout my career, and they have come in handy all the time. So these skills are a skill set you need to have in your toolbox, because even in markets that aren't like today, you will find uses for seller financing. So these are our presenters. We've got Jax Petty. He's the attorney, and he's a very good person to have on your list of professionals to help you through seller financing type questions. You definitely want an attorney running these deals, and you want a title company that knows how to do seller financing. There are many title companies out there who don't know how to do seller financing, and it turns into a mess. And frankly, seller financing throughout the industry, there are some areas of the industry that when you say seller financing, they just look at you like, I am not going to be involved in that. And they treat it like it's some plague to be avoided. In my opinion, when you do that, you show your ignorance. You show that you don't have the professional skills to include everybody in the market. That's why we're here. We're professional real estate agents. We should have these skills in our toolbox and not be afraid of them, and be able to help all of our clients, no matter what their needs are to get into homes. That's our job, is to help people get into homes. So we definitely want somebody who knows the world of seller financing on our team. Next, we're going to have George Anderson, who's a mortgage banker. He's been in this business for many, many years, and his mortgage company knows how to get people in and out of seller financing transactions. One of the greatest challenges of getting somebody into a seller financing contract is when it comes time for them to get a loan and get the seller financing contract refinanced. They will go to places like America First Credit Union, And America First Credit Union will say, I don't know what this is. We'll have to treat it as a purchase. That's the wrong answer. So you need to have mortgage companies who are familiar with seller financing. Their underwriters have done it before. They're not afraid of it. They know those loans can be sold, and it makes the transaction go very, very smooth. So George is going to take some time to talk about the lender's role of the seller financing world. And then there's me. I'm a real estate broker. I've been a broker since 1981. And I have done many, 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 many seller financing transactions. In fact, today in my business, probably 90% of my business is seller financing transactions. I kind of kid around to tell people that I am technically retired. But what do you do when you get retired? You don't sit on the front porch with a blanket over your knees. You do what you enjoy doing. And for me, doing real estate is what I enjoy doing for my retirement. But it's seller financing that allowed me to retire. I have enough passive income coming in from seller financing transactions that I can pay all of my bills very comfortably and then some. And so everything that I earn on the way of commissions and additional real estate transactions is all gravy. And that is one of the big benefits of learning seller financing. If I am a seller and I sell my house, and that may be great today, I get more than I'm asking and the market is great. But after I sell my house, how much income do I earn on that house? Nothing. I've sold it. That's not true with seller financing. I can be a seller and sell my house for more than asking price, and I continue to earn income on that sell. There's no other way you can do that except for with a seller financing transaction. Okay, well, let's jump into some of the things we're going to be going over. First of all, most of the time, a seller financing transaction is a short-term transaction. Many times the sellers are saying, well, okay, we have a buyer. They can't qualify for a mortgage right now, but they have $50,000 they can put down, and I'm selling a house for $350,000. And they've met with the lender. The lender says, well, you know what? They're self-employed, and they just need one more tax return before they can get a mortgage. So I'll do a seller financing contract for 3 years. That would give them plenty of time. Well, that's just a short period of time that I'm actually involved in a seller financing transaction, with the idea that the buyer is going to get a traditional mortgage and refinance that contract and get me out of it. So from a seller's point of view, most of the time, seller financing transactions are more like a bridge loan. And I'm not going to be involved forever. On the other hand, I have a whole bunch of sellers who have gotten the seller financing religion, and they do 30-year seller financing contracts. And why do they do that? Because they're earning a 16% return on their equity, and they earn monthly income, and they want to have that monthly income as a long-term investment in real estate. They don't have to be a landlord. They're a bank. So there's a bunch of very, very powerful motivation for a seller to do a seller financing contract that's a much longer contract. Most seller financing contracts, the buyer still has the option at any time to refinance, to sell the house. So they don't have to have a contract that lasts for 30 years. They're in control. They can sell the house at any time they want to. They can refinance their contract and get a better contract for them. But nonetheless, seller financing mainly is considered a bridge loan or short-term loan. The other thing we're going to talk about, and I'm going to turn the time over to George when we get to this section, is how do the banks look at seller financing? We want a bank involved to pre-qualify the buyer, to make sure we know that the buyer can, in fact, get a new loan when the contract is going to be over. You don't want to get a buyer into a seller financing contract that lasts for 3 years, and then at the end of the 3 years, they go to refinance, and the bank tells them, well, I'm sorry, but you had a foreclosure. you need 7 years before you can get a conventional loan after a foreclosure. So you still can't qualify for a loan. Now we've gotten the buyer into a very awkward position because they can't refinance the contract, and the contract is now due and payable. So we want to get a bank involved at the beginning. And also we want to make sure that the bank at the end knows how to refinance these contracts and get the buyer out. Also, we want to have the seller take a look at what the bank is, how the bank is going to look at this in terms of them qualifying for their next loan. Because a seller can be excited that they just sold their house, but now they're homeless. And now they need to go buy another home. So how did this contract that we just got them into, how's that contract going to affect their ability to qualify for another loan to get their new home? So those are the things that we're going to discuss when we get to that section. And then finally, we want to look at how does the law look at seller financing? I can't tell you how many agents have told me, oh, I don't do seller financing. That's illegal. And I said, excuse me? Yeah, I've heard that seller financing contracts are illegal. And I go, yeah, that's why we have a seller financing addendum on the MLS. That's why there's seller financing contracts on the Division of Real Estate's website, is because they want us to do things that are illegal. That is totally false. Seller financing is not illegal, but we want to make sure that we're getting our clients into contracts that are legal, that have been prepared by attorneys and closed at title companies. Too often, agents assume they know what they're doing, and they actually mess up really bad when it comes to getting people into contracts that they call seller financing contracts. So Jax Petty is going to spend a lot of time talking about the legality of seller financing and how to do it correctly. Okay, so let's talk about the 3 areas that are typically used in seller financing. The first one, most of us are totally familiar with, the lease option. That's part of our toolbox. We use it all the time. Typically, this is the type of contract we recommend to a buyer that we've taken down to a mortgage company. And the mortgage company says, I'm sorry, but you don't qualify for a loan right now. So the buyer and the agent, they assume that the only option for that buyer now is to rent, to do a lease option until they can qualify for a loan. And it doesn't matter what their situation is. They may be a fantastic family with great credit, but they're self-employed. And for some reason, mortgage companies don't like us that are self-employed. Maybe we're too good at making our taxes, minimizing our taxes when we do our tax returns, and we don't show any income on our taxes. Or maybe we've only been self-employed for a year and we need 2 years of tax returns. But for whatever reason, we can't get a loan now. And so we think the only option out there for us is to do a lease option. And that's not true. We can do a contract, a seller financing contract, where we actually buy the house. Obviously, there's a lot of advantage of buying a house rather than just leasing a home. And so most people would prefer to be a owner rather than a tenant. So that's the next type of contract, is a seller financing contract. Now, in the state of Utah, we call a contract where the seller stays on title, but sells the house to the buyer. We call that type of contract a uniform real estate contract. That contract is on the Division of Real Estate's website. So if you want to read through what a uniform real estate contract is, you can go to the Division of Real Estate and pull up that contract. I would recommend you do that because it reinforces for you that this is a legal way of selling a house. It's been around for over 100 years. I did not invent it. Jax Petty did not invent it. It's been there forever. We just, as a real estate industry, don't use it very often. And so we're not as familiar with it. Other states, in fact, the vast majority of other states in the country, call this type of contract a contract for deed. And by the way, this is your first key word. Contract for deed. It's actually 3 words, but it's an important word. Contract for deed. A contract for deed is a contract between the buyer and the seller, where I'm buying the house from the seller and I'm an owner. I have equitable title, but I don't get the deed. I don't get the transfer of title until I've paid off the contract. Thus the name contract for deed. And again, in the state of Utah, we call this type of a contract a uniform real estate contract. One of the reasons why I emphasize a contract for deed is when I go to refinance a contract for deed and I take it to a lender and the underwriter looks in their guidelines and says, let's see, they're asking me to refinance a contract for deed. Oh, there it is in my guidelines. It's right there. I can refinance a contract for deed even though the borrower is not on title. And so the underwriter can move forward and do that transaction. If I use the Utah version of this contract called the uniform real estate contract, an underwriter may go to her guidelines or his guidelines and they won't find a uniform real estate contract anywhere in the guidelines. And they may come back and say, I'm not comfortable trying to do a refinance when it doesn't specifically spell that out in my FHA, Fannie Mae, Freddie Mac, VA guidelines. And so they'll say, let's try to treat this as a purchase then. I don't want to treat it as a purchase. I want to treat it as a refinance so that I can use the current market value for my loan to value ratios so that I don't have to come up with money out of pocket. So I don't have to verify my down payment that I gave to the seller 3 years ago. I want to use this type of a contract and refinance it, which all the guidelines on all these different types of loans show that I can do that. But it's important that I have a contract that's called a contract for deed. So that's what I recommend you use, is a contract for deed. Now, what's the big difference between a contract for deed and a uniform real estate contract? The title. That's the big difference. The title at the top of the page. They're almost identical in terms of the actual wording and the nature of the contract. So this is an important one, contract for deed, and that's your key word for this section. And finally, the other type of seller financing is an all-inclusive trust deed. And note, and this is where the seller actually passes title to the buyer. Just like a normal transaction, they're selling it, they give a warranty deed to the buyer. And in that warranty deed, if they have an underlying mortgage, they're going to put a clause in the warranty deed that says subject to an underlying mortgage. They're going to say, I'm not going to pay off my current mortgage, but I'm still going to transfer title to you as the buyer. So now you're on title. And I'm going to record a trust deed, just like the banks do. I'm recording a trust deed that identifies that there is an underlying mortgage that needs to be paid when you make your mortgage payment to me. So you're going to make a mortgage payment to me. I'm going to make the underlying mortgage payment out of that payment, and then I get the difference. But the buyer is on title in this type of a transaction. Now, frankly, there's a little bit of a gotcha on this kind of a transaction. Number one, all mortgages have on them a due on sale clause. And this is one of the reasons why most real estate agents who aren't familiar with seller financing will tell you that doing a seller financing contract is illegal. And that is because the mortgage that's on the house has a due on sale clause, which states if the borrower or if the person who's on the mortgage sells their house, the mortgage has to be paid off. So if I sell a house and I don't pay off my mortgage, am I doing something that's illegal? The answer to that question is no, you're not. You have every right to sell your house. And yes, the mortgage company has the right to call the loan due and payable if they choose to do that. How do they do that? Well, they have to actually send you a notice that you are now in default, and they have to begin the foreclosure process. They can't just take your house away from you. It's the exact same process as if you didn't make your house payments. They have to foreclose to actually enforce their due on sale clause. It's very, very rare that a mortgage company will exercise that right and actually start foreclosure and do a due on sale. But I can't tell the buyer and seller that that won't happen, because when a seller transfers title, the mortgage company will know that the house has been sold. And so the due on sale clause is more likely to be invoked by the mortgage company. Now let's back up a little bit. Do I have the right to sell my house on a lease option where I've given an option to somebody to buy it? And can the bank call the loan due and payable based on their due on sale clause? Do I have the right to rent my house or to lease it with an option without worrying about the due on sale? The answer to that question is absolutely I do. The mortgage company has zero right to call the loan due and payable if I lease my house or do a lease option. Why? Well, because I am still on title as the owner of that house. With a contract for deed or a uniform real estate contract, who's still on title when I sell a house on that type of a contract? The seller is still on title. Just like a lease option, the seller stays on title until the contract has been paid in full. So most mortgage companies will look at a contract for deed or a uniform real estate contract the same way they look at a lease option. Their borrower is still on title. And so there is no attempt to call the loan due and payable based on the due on sale clause. So this is a very good reason to use a contract for deed, is because your bank that has the underlying mortgage is not going to call the loan due and payable because their borrower is still on title. Okay? So those are the three main seller financing type contracts that we typically get our buyers and sellers involved in. So I'm going to pause. Does anybody have any questions? I've gone over a lot of stuff.
This is Brandon. The all-inclusive trust deed, would that make it so they have the due on sale clause, because technically then the buyer is actually on title?
That is correct. So the due on sale clause is more likely to be invoked by the underlying mortgage company when title has transferred. Now, how does the underlying mortgage company find out? You're not under any obligation to call them and tell them or send a letter to them, and you're not being deceitful or dishonest if you don't. You don't have to get permission from them in order to sell a house on a on an all-inclusive trust deed. But they will find out because they pay the taxes. They get the insurance notice from the insurance company. When they get the tax notice, they're going to see that title has transferred. Even though the payments are still being made without any problem, they will find out that the house has been sold and title has transferred. And at that point, if it comes to their attention and they choose, this is a choice, this isn't mandated, they can choose to call the loan due and payable. Now, I've bought many a house on a all-inclusive trust deed, and I've been flagrant about the fact that I bought the house and I'm on title. I'm sending my payments to the underlying mortgage company directly. I have never had an underlying mortgage company call the loan due and payable. I had once Chase send me a letter saying, this loan is in default. I said, oh, really? I said, okay. So I took the letter from Chase and I threw it in the garbage can. And I sent them another payment. And lo and behold, they cashed the payment. What happened to their ability to foreclose on the due on sale clause if they cashed the payment? They just nullified their foreclosure. They have to start all over again. So a bank, in order to exercise their due on sale clause, they actually have to stop accepting payments. What's the likelihood that a bank is going to want to take a mortgage that is a performing mortgage and take it and put it into their foreclosure department and foreclose on that house when the payments are on time? I'm not saying that they couldn't do it. They have that right. But in my experience over the last 50 years, they don't do it. But that doesn't mean they couldn't. Okay? Does that answer your question, Brandon?
Slightly. As far as the you used your example of the contract for deeds, I totally get that. When you're using the all-inclusive and putting them on title, you're saying you've never seen them follow through with it.
I've never seen that, but that doesn't mean that they won't.
Correct.
Now, in the early 80s, when savings and loans were in the business, that's all they did was mortgages. They had mortgages out at 8%, but they were paying depositors 12% on their savings accounts, on their accounts. So they were paying out 12%, but only receiving 8% on their mortgages. And when we did a seller financing contract where we passed title to the buyer, we got savings and loan companies who actually tried to use their due on sale clause and call the loan due and payable. So that was an example where we actually saw that. That case went to a California Supreme Court in California, and the California Supreme Court ruled against the mortgage companies. But that's not the case. I mean, right now, every single mortgage has a due on sale clause. And in our seller financing addendum, we actually disclose to buyers and sellers that there's a due on sale clause. Should the bank choose to call the loan due and payable, whose responsibility is it to pay off that loan? And in the contract, it specifically puts that responsibility on the buyer's shoulders. They have to either sell the house or get a loan and pay off the underlying mortgage. Okay, Brandon? Okay, any other questions? Okay, we're going to move forward then. So today, when it comes time to, we've got 3 hours with you, and seller financing is a huge, huge topic, and there's many ways that you can use it. And I have hundreds of examples of using seller financing to meet the needs of both buyers and sellers. I don't have the time to go through everything about seller financing. So we're just hitting the tip of the iceberg when we talk about seller financing in this 3-hour CE class. So I apologize that you're not necessarily going to be experts at the end of the 3 hours, but you're going to know enough that you can realize that this is going to be very, very useful in your business. And when those times come available for you to use seller financing, you can say, okay, I've got to go find some experts to help me through this. When I first got into real estate and got my real estate license, I did not feel like I was an expert in real estate. I had to use people who had been around the block to help me through my first transactions. Seller financing is no different. You tell your buyers, you tell your sellers, this is a technique that would be very useful in this situation. I've got some other people who know their way around this that I'm bringing in as consultants to help us with this transaction. They won't look at you like you're stupid. They'll look at you like, great, you have other professionals that will help us that have this type of expertise. So don't feel shy about bringing people into the conversation to help you through a seller financing transaction that you may not totally feel comfortable writing up. Okay, so I'm going to pause for a minute and turn the time over to George Anderson. George, like I said, has been in the business for many, many years. He's an excellent resource for seller financing, both from the buyer's point of view and from the seller's point of view. Like I said, sellers need to know how these transactions are going to affect them in buying their next house. So George, I'm going to go ahead and turn the time over to you. Do you need me to run the slides?
Yeah, so Dave and I have to tag team here just a little bit because Dave's video isn't working and my screen share isn't working. But between the two of us, I think we can pull this off. So a lot of people would ask, well, what would be the purpose of having a lender involved in a seller financing transaction? Well, I'll give you an example. I mean, granted, we are in a little bit different market right now, but Dave and Jackson and I first put this class together. This class was first approved in 2009. We've been teaching this class now. This is our 12th year of teaching this class. Has the market gone through some changes since 2009? Yeah, okay, it has. And I've been in the business since 1989, full-time in the mortgage business. And I can tell you that, each decade prior to that had unique circumstances, but there are, there's a connection between structuring your transactions and so that they are ultimately successful. A seller financing transaction, the best way to look at it is that it's a delayed institutional loan. Now, sometimes it's not. Sometimes it might be a 30-year contract like Dave was talking about. But the majority of those contracts are going to be short-term. The seller's like, well, that's okay. I mean, if the seller needs a year or 2 years or 5 years or whatever, that's okay. I'm okay taking, most of my equity or some of my equity right now and retaining some cash flow in addition to that, because the seller finance buyer is willing to pay more money than somebody who is getting financing or paying cash. So there's some benefits to doing that. But the seller on every seller financing transaction basically wants the answer to just 3 questions. Okay, he says, I'm coming to you with a seller finance buyer. And the seller's natural reaction should be, why? Can't he just go and get a loan? Well, the seller needs to know what is the problem. Then they need to, okay, all right, well, I understand. Okay, he's got a new business. He hasn't filed his tax return on it yet, or he's filed one and he needs to file another one. Then it's like, okay, well then, can it be fixed? Well, yes, it can be fixed. It can be fixed by filing another tax return. And that might be, if we're dealing with somebody in that situation, that could be February, March, or April, or whatever of this year of 2021. So every seller on a seller finance transaction just wants the answers to the 3 questions here. What's the problem? Can you fix it? And how long is it going to take? And then based on that, the buyer and the seller then negotiate. And, and some of these sellers will say, well, what interest rate should I charge? And I go, Dave, what would you like to get? This is a negotiation between you and the buyer at this point. So my job as a lender, even though somebody knows that they don't qualify, do you as a real estate agent, let's just say you've got a seller finance buyer that's looking at a $500,000 home that they want to buy with seller finance, and they have $50,000 to put down. And the buyer, did some searching online and found out that he's going to qualify in 6 months based on a chat room or something that he found out online. And he tells the real estate agent, you're representing the buyer. He says, you know what? I only need 6 months. So just tell the seller, I just need 6 months on my contract. And they put down $50,000. The seller accepts the money and they have a contract. And we find out 6 months into the transaction, the buyer now actually goes to a mortgage company and applies, and the lender's looking at it and I'm going, I don't know where you got the idea that you're going to qualify in 6 months. You are a 12 to 24 month project minimum. The buyer, okay, if the seller decides to exercise their rights to cancel the contract or whatever forfeiture procedures they have, depending on the contract, what's going to happen to your buyer's $50,000? Does he get to keep it? Or is he going to lose it? He's going to lose it and he's going to lose the house. Okay. And if you were representing him as his agent, do you think that there's a chance that the buyer would maybe go after you? Okay. To be able to say, well, why didn't you tell me that I needed more time on my contract or whatnot? So again, as a real estate agent, you really don't want to be making the call on this last one here, is that, how long is it going to take? I mean, I don't care if somebody's had bankruptcy, foreclosure, if they've got IRS tax liens, if they've got $1 million of past due child support or whatever. There's never any situation with a buyer that their time frame for qualifying is never. There's always a time frame. It might be 5 years, it could be 7 years, it could be 6 months. But if they're going to be applying for a mortgage loan at some point down the road, and that mortgage loan is going to cash out the balance of the seller's equity on the property, you want to have a lender involved to be able to make that call and to be able to and to be able to work with the buyer and tell them what's going to happen on that. So I think we can go to the next slide, Dave. So, okay. So there's any number of problems. I mean, I could bring in a hand truck that would show all the underwriting guidelines for Fannie Mae, Freddie Mac, FHA, and VA. And in there, what you're going to find out is here's all the reasons that we can say no, right? Okay, so sometimes that people ask, well, what's the purpose of an underwriter? Well, you know, the purpose of an underwriter is basically when a file comes in, and I'm being a little bit sarcastic, but you know, it's like, okay, this buyer is lying. Let's see if he can prove that he's not. Okay, so it's a matter of just figuring out, you know, is there enough income? Is the credit sufficient? The debt ratios work and everything like that. But there's never any kind of a problem, again, that can't be solved on here. And there's a lot of great people out there that they can afford to put a roof over their head. They have a significant down payment that they can come up with that will give them an ownership interest in the house, that will give the seller, you know, a good portion of their equity, and the seller can retain some cash flow. But everybody needs to know, you know, what are the expectations for this buyer? I mean, there are some people that might have situations, maybe an immigration status, and the answer is, well, how long is it going to take to fix that? The answer to that could very theoretically be an I don't know. And those are ideal situations for putting together a 30-year seller financing contract. And I've personally worked with Dave on putting several of those together where it works. The buyer is happy, the seller is happy, everybody gets what they want. And but again, it's just a matter of transparency and full disclosure, and everybody knows what's going on. So next one, Dave. Okay, so we're in a market right now, and we have been for a little while, where you know, probably not a lot of people out there doing seller finance transactions. You wouldn't think there are. Dave, how many have you done in the last 12 months? How many seller finance transactions you've personally been involved with?
Probably close to 25.
Okay, so somebody's doing them out there, and there's a way to do it. In fact, my oldest daughter, who's 30 years old, has already bought and sold her first property seller finance, and she's got 2 more that she's going to be getting probably within just the next few months. I mean, she made a very nice, handsome profit on one that she had gotten earlier that they sold last year, and they're getting ready to do another one. When we're in an environment here where it's just everybody wants to grab the low-hanging fruit, I want the conventional buyer with 20% down. If I've got 13 offers on a property, why am I having to hit my reset button so often here? I don't know. But there's not a lot of people that have the patience to work with people that may not be prime time. They might not be ready for prime time. I've been in the business for 32 years, and I think anybody that's been in the business for 5 years or longer knows that our business, whether we're on the title side, the real estate side, the mortgage side, or whatever, we are a relationship business. And our credibility, our ability to get referrals, depends upon our ability to connect with people and you know, and get into their sphere of influence. And so I've got several transactions at all times. I mean, I've got sometimes it's literally a long legal file of folders that are what I call that are people that are under construction. I'm not a builder with homes that are in inventory that are under construction, but I have people that are under construction. And I think on any given month, I probably have at least 1 or 2 of those people that I may have been working with from anywhere from a 90-day period to sometimes maybe a 2-year period before they're ready to go. So the idea is that we don't want to have a referee mentality when we are working with our clients. We want to have the mentality of a coach. And as a coach, you're going to be able to get a lot more referrals. You're going to be a lot more effective in getting the confidence and having people that'll work with you. I mean, in my experience, the people that I've had to kind of coach and kind of bring them up and work with them for a little while, those people have always been much better referral sources to me than the people who, you know, have the 800 credit score, 20% down. And I mean, let's face it. I mean, the real estate agent, the lender, everybody involved in the transaction, we are treated as a commodity rather than as some sort of a valued professional. Say, well, I know I can go buy any house and I know I can qualify for any loan. And, you know, but the people that need a little bit of help, I think that's where we cut our teeth and that's where we earn our credibility. So, but anyway, so let's do that as a keyword. Let's go in there. Let's put in the word coach. So that will be our second keyword that will come from me. All right, what's our next slide, Dave? I think I know it. So as Dave mentioned before, Jax and Dave, myself, none of us have invented anything. Okay, this is stuff that is literally been in the underwriting guidelines. I have an underwriting manual from when I started in the business. I think that it's called, the FHA was called the 4155 way back then, and it was a 1986 version of it. And in the 1986 version of it, it refers to a contract for deed transaction. It says that, you know, if the buyer is not untitled, that they can refinance if they own the property by a contract for deed or other similar type of financing arrangement. And so that includes this contract for deed that we've been talking about here. And again, we want to make sure that the language on our contracts pairs up and matches with what we're going to see on the underwriting guidelines. If the underwriter has to start, you know, you don't want to put an underwriter in a position where they're having to exercise a lot of thinking outside of the box. Because if they can't find out where what you're trying to do pairs up with the underwriting guidelines, it seldom ends up being a good thing. But, you know, I've personally refinanced, I'm going to say comfortably over 100 of these transactions where somebody comes back and they're refinancing a home that they are not on the title. And people will say, well, how can you refinance something that you don't own? Well, sit and think about it, okay? Has anybody ever refinanced a vehicle? Yeah. Well, who's got the title on the vehicle when you refinance it? It's not in your possession, it's in the bank's possession. But yet you can still refinance that. And then that title would transfer from the old bank to the new bank. Okay, so the same thing here. And then when you pay off the car, then the bank says, oh, okay, now you fulfilled your contract, here's your title. Jax hates when we use this example because it's, I guess under statute law, it's not exactly the same thing, but it's a practical application. But anyway, so there's a handout that we have sometimes with this, and I don't know that we've updated it very recently here, but contract for deed is mentioned in the VA guidelines. It's mentioned in the FHA guidelines. It's mentioned in Fannie Mae. It's mentioned in Freddie Mac. This is something that we are not inventing anything. We are literally applying some guidelines that don't get a lot of notoriety, and maybe in the market that we're in right now, you may not think that there's much use for them, but I think last year I probably did at least 10 to 13 or 14 transactions where I was refinancing somebody's contract for deed. And the nice thing about that transaction, the way that it was structured, is that these were people that bought their house 2 years ago, maybe put down $20,000, which at the time on a $30,000 home was only a 15% down payment. Okay, well, $300,000 home 2 years ago, what's it worth today? Quite a bit more, right? The nice thing about refinancing a contract for deed is that they get to refinance it based on current value. So now these people who may not have qualified for even an FHA loan at the time 2 years ago are now refinancing their contract for deed and getting a conventional loan without mortgage insurance, because the equity in the home is theirs. They own the equity. So that 20%, 15%, whatever the appreciation was on that home over the last 15 years, the person who bought that home on contract for deed, that is their equity. So I'm not going to get too much into some of these underwriting guidelines here, but the other side of the coin is, how does seller financing affect the seller? So there's always, you can't pick up one end of the stick without the other end moving also. So if somebody comes in and they purchase a home on a contract for deed, the seller now says, okay, this is great. I've got cash flow. Well, can I show that income to the underwriter? The answer is yes, you can. And for most of the contracts that we would structure, and the way that Jax does his at his office, the way that we structure these is that it is going to be treated most of the time, and I'm going to let Jax get into the differences on this, but most of the time it's going to be treated as rental income. It's going to be treated as rental income. So the seller can show that income. Second thing on there is can the seller purchase another home immediately? And the answer is yes. Now, there was a time not too long ago where, I mean, even, 12 years ago when we had the buy and bail rules. Does anybody remember the buy and bail rules? Like if somebody wanted to purchase another home and say that they were going to rent the house that they were in, well, you had to have, a substantial deposit and 12-month lease, and you had to have 75% loan to value. You had to have an appraisal on the home that you were converting to a rental or that you were proposing to rent. And you'd still have to qualify for both payments. Well, all those underwriting guidelines over the course of the last 12 years have relaxed and relaxed. So this is a moving target. This is one of the reasons why we don't get a whole lot into the underwriting guidelines during this, because they've changed a lot in the last 12 years on a lot of aspects of this. But for the most part, the answers to all these questions that are coming up here are their best case scenario. Yeah, I can show the income. Yeah, I can buy another house immediately. There might be some times where you have to wait a little bit longer, but more often than not, no. You're going to be immediately be able to sell that house on seller financing. Use the down payment that the buyer gave you for that towards the down payment on your next house, and be able to count that cash flow to help you qualify for the next one. So that's pretty exciting option for a lot of people who maybe don't want to cash in 100% of their equity yet. Where are we at next, Dave? And then, yeah, can I make money on the bank's money? Now, I'll let Jax or Dave dive into this one when I hand it back over to them. But if somebody owes $300,000 on their home and their interest rate is at 3%, and you sell your home on a seller finance contract, and your seller finance contract is they owe you $350,000 and they owe you at 6%. Somebody was asking, how do you get 16% rate of return on your money? Well,
George, can you see this Excel spreadsheet?
Oh yeah, Dave's got a spreadsheet for that. So, okay, so Dave will bring that up. So the answer is that no, you're not making a 3% rate of return or a 6% rate of return on your money. There's leverage there. And there's a very handsome calculation on getting that leverage. And it's going to be in the teens and sometimes in the 20s, the rates of return on this. And yet you're giving your buyers a very good transaction that meets their needs. So making money on the bank's money, I mean, that's what the banks are doing with us anyway, correct? I mean, the banks aren't lending out their money, they're lending out your money, your deposits. So it's the same thing. Dave in the class used to tease, he says, everybody knows what OPM is, right? And Dave's like, I bet you don't. The answer is other people's mortgages. So anyway, so go ahead, Dave, you can go to the next one there.
Okay.
And I think, yeah, okay. So this is where I hand it back off to Dave here. But, and then just a quick thing there were some chats on here. I don't know that Jax is on. I answered some of the chat questions on there. That was me answering. I'm not an attorney, but I do speak 16 words of Latin. So I'm really close. And I've listened to Jax give his answers probably 100 times. So I'm just putting my disclaimer on there. So anyway, but back to you, Dave.
I'm
Okay,
on,
let's
George. I'll cover some of those when it's
Okay.
my part.
Okay. All right. Fantastic.
So George was talking about how does the seller make money on the bank's money? And this spreadsheet that I put together is a tool that I use to actually show sellers how to make money on a seller financing transaction. So on the left here is the buyer's contract for deed. And hopefully you guys can.
Shut up, Dave.
What's that? It's not up?
You don't see the spreadsheet.
You don't?
Anybody else see it?
No,
Oh, nobody can see the spreadsheet. All right, well then, can you see the PowerPoint again?
You can see the PowerPoint, yes.
And not the spreadsheet. Okay, well then I won't worry about the spreadsheet. Sorry about that. But nonetheless, it's the basic concept is a seller has a mortgage that is a lot lower interest rate than what their contract for deed interest rate would be. Are there sellers that have mortgage interest rates as low as 3% or even lower today? And the answer is yes. There's some phenomenal rates out there. So if I'm a seller and I'm willing to do seller financing, I've got two things that I'm selling. I'm selling the house, yes, but I'm also selling a financial asset. I have the ability to provide financing for the buyer. So now I'm a bank. What kind of an interest rate can I get as the seller on my seller financing contract? I do seller financing contracts every month where the interest rate on the contract is 7.25%. That means that if I have a loan on my home that's at 3.25%, I'm making 4% on the bank's money. So I'm not just getting 7.25% on my equity, I'm actually getting 4% on the bank's money, which my rate of return then on my equity is closer to 17%. So why would a seller even think about doing seller financing? Well, that's a good reason. I'm making a lot of money. Where can I make 17% return on my money and have it secured against something like seller financing, like real estate? I couldn't take that same money and put it in the bank. They'll pay me a whopping 0.25%. And so seller financing is an excellent investment for sellers. Many times I'll sit down with the seller at a listing presentation. One of the first things I bring up is let's look at the advantages of doing seller financing. And typically the seller will say, well, no, Dave, you don't understand. I just want to sell my house. Okay, that's fine. But let's look at some of the options you might have if you sell it on seller financing. And after I finish talking about seller financing, the sellers are going, well, I would be open to that. I had one attorney that was interested in selling her rental property. And I gave her the seller financing pitch. And she says, no, Dave, I just want to sell it and be done with it. I said, okay. I said, but at least let me list it with the option of seller financing. Because even if you have a buyer that brings you an offer with seller financing, what can you always say if you don't like it? You can always say, no, I don't particularly like those terms or that seller financing offer. So you're not committed to have to sell it seller financing. Well, we put it on the market. We put seller financing as an option. A week later, she got an offer that the buyer had $50,000 they could put down. They just needed a year. They were a VA buyer. They needed a year before they could qualify. And she looked at the offer and says, I'm totally fine with this. Let's do it. This was an attorney, a judge, who told me at the beginning, no, I don't want to do seller financing. But when actually presented with the offer, she said, no, I'm down. This is a good deal for me. And I make money on the bank's money. So seller financing is a wonderful tool. It's actually kind of fun. One of the things I really like about seller financing is how dynamically it can be structured. I am in the business of bringing buyers and sellers together to make something work for both of them. So if I have a listing where I'm advertising seller financing, a buyer's agent will call me up and say, Dave, what are the terms of your seller financing contract? Legitimate question. Absolutely. But I don't give them a set number of terms. I tell them, I say, that kind of depends on your buyer. Let's talk about your buyer. Let's talk about my seller. Let's negotiate the terms. And so we have a conversation. It's not a set number of terms. I have buyers that come in, they say, well, we need this amount of years before we can qualify, but we need this house payment. I said, okay, my seller's willing to do an interest-only loan for 3 years. That gives you your house payment that you want and the term that the seller wants. The seller gets their interest rate that they want, and you can afford to buy this house. So the terms can be negotiated back and forth between the buyer and the seller. And there's hundreds of different variables to that make those type of things work. Maybe I want to do a lease option for the first year and then do a contract for deed. I can do that with seller financing. Maybe the buyer has $50,000 they want to put down now, but in 6 months, they're going to get a house in California sold, and they're going to have another $50,000 they can put down in 6 months. And they want their house payment recalculated when they put the other $50,000 down. I can put that into the contract. Try to do that with a VA loan or a conventional loan, where I put $50,000 now, and in 6 months, I give the bank another $50,000 and ask them to recalculate my monthly payment. They won't do that. They'll say, no, you have to actually refinance your loan. You have to start all over. I don't have to do that if I'm doing a seller financing contract. I can put that into the terms. So it gets kind of exciting as to the type of things that you can put together to help a buyer and seller make a transaction work. All right, so let's talk about these things really quick. Number one, a contract for deed is very similar to our Utah uniform real estate contract. We've already talked about that. People ask me all the time, can I do a seller financing contract if my seller has an FHA or a VA loan as the underlying mortgage? And the answer to that question is yes, you can, but you need to use a contract for deed so that title does not transfer. If you use an all-inclusive trust deed, VA and FHA actually have a guideline out there that says that that is a violation of their rules. And you could be sanctioned as an agent or a title company if you do a contract for an all-inclusive trust deed over the top of a VA or an FHA loan. And I really don't want to get into a lot of that, but there's a lot of agents who have told me, I've always been told that I could lose my license if I do a seller financing and the underlying mortgage is an FHA or VA loan. So when I heard that, I actually went to the Division of Real Estate and I said, can I lose my license if I do a seller financing contract over the top of an FHA or VA loan? Their answer was, Dave, the last time we looked, we're the ones that give you your license, not FHA or VA. So the answer is no, you cannot lose your license. So what can FHA or VA do if they're not happy about somebody doing an FHA or VA loan? Well, I mean, a all-inclusive trust deed when there's an FHA or VA loan as an underlying mortgage, they can put you on the limited participation list. That's all they can do. But that's significant, and you don't want to be on that list. And so I'm very careful if I've got a seller who has a VA or FHA loan, the only type of seller financing that I will do is either a lease option or a contract for deed. I will never use an all-inclusive trust deed where title is passed if the underlying mortgage is an FHA or VA loan. Okay, so with a contracted deed, again, the seller retains title. The buyer has what's called equitable interest in the property. And Jack will talk a little bit more about that. Now, one of the problems I do have is with utility companies. The buyer goes down to Sandy City and they say, I just bought a house. I put $50,000 down. I want the water in my name. And the nice lady at the water department looks up and she goes, well, you're not the owner. And the buyer says, yeah, I am the owner. I went to a title company. They gave me a contract. I signed all sorts of closing papers. Here's my closing papers. I'm the owner. And the nice lady at the counter says, well, the county says you're not the owner. And what they're confusing is who's on title. And the water company is right. That buyer is not on title, but they are an owner based on the definition of ownership. They're just not on title. And Sandy City, because of their limited rules, they will say to the buyer, well, I'm sorry, you're not the owner, so you can't put the water in your name. So how do we work around that? Well, we have the seller keep the water in their name, but Sandy City will send the water bill to the buyer and the buyer can still pay the water bill. So these are some of the nuances about doing seller financing, that there are total workarounds. We can still succeed in doing the contracts. We have to just pay attention to the fact that the rest of the world isn't up to speed on seller financing and ownership definition based on a contract for deed. So how do I write a seller financing contract? Well, in the first place, we use the regular REPC. And we use a seller financing addendum, which are both on the MLS. And so we just need to be familiar with what those contracts say and how to fill them out. Now, if I'm doing a lease option, I'm not going to use a REPC. I'm going to use the lease option or lease with, it's called a lease with option to purchase on the MLS. And so that is my contract. I don't also use a REPC. I only use the lease option that's on the MLS. Now, if I'm going to use a all-inclusive trust deed, then I have a title company prepare that document. And that's what I'm going to have as a closing document, is an all-inclusive trust deed and a warranty deed that's subject to the underlying mortgage. Now, on my REPC, the seller financing addendum, I am actually going to select, when it comes time for how am I going to close on this contract, I'm going to select other type of contract because it only gives me the option of a all-inclusive trust deed. And the other thing I'm going to select other, and I think Jax goes over this, and then I'm going to write in contract for deed on the seller financing addendum. That's how I'm going to close this transaction. So if seller financing can be such a great benefit, how come there's so much resistance in the marketplace for seller financing? Well, first of all, most owners don't even know this is a possibility. If I go to a seller and I said, would you be interested in selling your house on seller financing? 99% of the sellers out there are going to say, no, I just want to sell my house. Once I sit down and talk to them about seller financing, the more typical response I get from sellers is, why don't more people do this? Not, oh, I don't want to do seller financing, it's illegal. That's not what I get. I get from sellers, why don't more people do this? Because now they understand the benefits of considering a seller financing contract. The bigger place I get resistance on seller financing are from real estate agents who don't understand seller financing. And I have way too many real estate agents. When I call them up, I say, hey, I would like to present an offer to your seller. Well, that throws them for a loop right there. They say, you want to do what? I want to present an offer to your seller. And it just blows their brain out. No, just fax it to me. Wait a minute. Faxes are old technology too. Email me the offer and I will present it to the seller. Well, if I email a seller financing offer to a listing agent who's not familiar with seller financing, what is the likelihood that the seller is actually going to accept that offer? Zero. It's not going to happen. And so typically what I have to do is I have to say to the agent, the listing agent, well, there's a lot of reasons why I actually want to present this offer in person. Is there anything wrong with that? Am I doing something illegal by sitting down with the seller, with the listing agent there? No, of course not. But most listing agents won't let me get past them. So finally, I just have to say, well, at least let me meet you at your office so I can explain the offer to you. And most real estate agents won't bother with it. They say, look, I've already got 15 offers on the table. Why would I want to pay any attention to your seller financing offer? And they shut me off. Is there a problem with that? from a seller's point of view. Yeah, there is a problem with that. Does the seller have the right to hear and have all offers presented to them? Is it our responsibility as a listing agent to say which offers they can listen to and which ones they can't? You're taking some liability there if you pre-select which offers the seller can look at. It may very well be that a seller financing offer would be a perfect thing for that seller. They make more money, they get cash flow after the sale is over. It could be a terrific deal for them. And yet you're interfering with their ability to field all offers. So we have, in my opinion, we have to be careful as listing agents not to pre-select offers that we will or will not present to a seller. But anyway, that's my 2 bits on that. Okay, things to think about. Seller financing transactions are put into the MLS as actual sales. They're entered as legitimate comparables. A appraiser can use a seller financing sale as a legitimate comparable on their next appraisal. Seller financing transactions can be great for investors. If I want to buy real estate as an investor and I go to a bank, what's the minimum down payment most banks are going to require?
20.
A lot of money. They want 25% down. I can go to a seller and I can negotiate a seller financing contract. And many times the seller is very happy with the 10% down payment. If I go to a bank and I have 20 properties, which I've been there before, and I go to a bank and say, I want to buy another house. And they look at me and say, well, Dave, we love you. You got lots of money here. You've got all sorts of good credit. You have reserves, but you have more than 10 loans out already. I can't give you any more loans. Fannie Mae, Freddie Mac, that you've reached your limit. You can only have 10 loans. And I have investors that say, Dave, I want to buy 100 houses. And I'm going, well, good luck with that if you want conventional financing. Now, there are lenders out there who will loan to investors, and they don't care how many loans you have. Their interest rates are a lot higher than traditional lenders. So as an investor, if I want to buy a lot of real estate, hey, seller financing is a good option. It very well may be that I will find a seller who would be willing to negotiate my terms and give me a contract on a seller financing house, and I can buy and add more homes to my portfolio. It could be a terrific thing for flips. Maybe I don't want to pay cash for a house. Instead, I just want to work out a deal with the seller to keep their mortgage in place while I'm fixing up the house. And after I fix it up, then I turn around and I'm going to sell it and cash out the seller. And if I'm a flipper and I'm doing quite a few flips, instead of having to go to a hard money lender to get my money, I go to the seller and I have them be the lender while I'm doing the refinance. So instead of paying 12% interest, I'm paying the seller 7% interest. I mean, these things can be a really good advantage for those of us who are active in buying and selling real estate. If I have a Roth IRA, I can't put $50,000 from my Roth down on a house and get a conventional loan for the rest, because Roth IRAs will not allow recourse lending. They have to have non-recourse lending, which means I can't come against the buyer, the borrower. So a Roth IRA cannot use traditional lenders to buy a house and get a loan. Well, if I don't have $400,000 in my Roth, I can't buy real estate. But I can buy real estate using seller financing and have $50,000 from my Roth as my down payment and have the seller give me a loan, a contract. Seller financing is great for 1031 exchanges. So there's lots of different scenarios in which seller financing could be the exact ticket I'm looking for in order to buy or sell real estate. How long does it take to close a seller financing transaction? I've done a closing in 2 days on a seller financing transaction. That doesn't necessarily mean I should. I very well, especially if I'm an agent representing a buyer, I would want to have the buyer do a due diligence home inspection. I would want to do the same things I would with any other transaction. But it doesn't necessarily have to be that way. So I've had buyers come to me and say, hey, I've got a 1031 exchange. I've got to find a house and close on it within the next 3 days. Can you help me? And I've closed on a seller financing contract in 2 days for them so that they didn't lose their 1031 exchange window. So it doesn't have to be 45 days or 30 days like a traditional loan. It can close very, very quickly. And Jack Petty's office can do them very quickly. What about closing costs? Well, with traditional loans, how much does it cost to do a traditional loan? We tell buyers that they need to plan about 3%. Well, not so with seller financing. Seller financing, you can get by with $400 aside on your settlement fees and title insurance for the seller, and there's no loan origination fee, no underwriting fee, I mean, you don't even have to have an appraisal if you don't want to. So seller financing closing costs are significantly lower than traditional loans are. So that's another major benefit for seller financing. If I close a seller financing transaction, I'm going to go to a title company to do that. I get a HUD statement. So I get settlement documents. I get an owner's policy of title insurance as the buyer. I close with legal documents that are prepared by attorneys, so I know that it's been done correctly. Those sales can be valid appraisal comparables. I've had appraisers call me, say, Dave, tell me about this transaction that you just closed. And I'll tell them about it. And I said, great, I can use it as a comp. Now, back in the days where short sales and foreclosures were prevalent, I would go in and I would sell a house on seller financing $30,000, $40,000, $50,000 over what other houses were selling for. And I would have appraisers call me and say, Dave, how in the world did you do that? And I give them the terms, I give them the scenario, and they go, fantastic. I can use this as a comparable for my appraisal. So I personally take responsibility for turning the market around during the time when we had foreclosures and short sales by doing seller financing. And I don't see anybody laughing about that. So I will rescind that claim. But nonetheless, seller financing, you can use these transactions as appraisal comparables. Okay. Last thing is any seller financing transaction, you want the monthly payments to be done by a third-party escrow company. You don't want the buyer making their payments directly to the seller. You get a third-party escrow company in the middle. So the buyer makes their payment to the third-party escrow company. The escrow company makes the underlying mortgage payment so that they make sure that that's being kept current. And then they send the difference to the seller. The other major benefit of a third-party escrow company is they keep track of all the accounting. They know when the payments have been made on time. They know that the buyer is, when the contract is about over, they know that the payments have been made and that the buyer is legitimately able to buy out the contract. And they hold documents such as a quitclaim deed to give title to the buyer when the contract's paid off. They also send all the documents necessary to the IRS at the end of the year. They send a 1099 to the seller saying you've received so much in interest. They send that same document to the IRS. They send a 1098 to the buyer saying you've paid so much in interest. They send that to the IRS so that all the tax ramifications of normal ownership are fulfilled with a seller financing type contract. How much do seller or to third-party companies charge? Well, they charge about $100 to set it up, and typically around $20 as a monthly fee to do the, to take care of the transaction. Many times buyers and sellers will split that cost. It is well worth having a third-party escrow company involved. Just yesterday, I met with a buyer who bought a home on a seller financing contract where they were making the payments directly to the seller. And they were beside themselves with anguish because last week they got a notice put on their door that the house was going into foreclosure. The seller was taking the entire payment and putting it in their pocket. They were not making the underlying mortgage payment. Now, what does the buyer do? Well, they can sue the seller, yes, for breach of contract, but that may or may not be successful in time to stop the foreclosure of underlying liens. You want to make sure as a buyer that you know exactly what liens are on the property and that those underlying mortgages are being made, the payments are being made every time I make my payment. So it's critical that a third-party escrow company is involved. Okay. Finally, as a seller, if I sell my house on seller financing and the house will appraise for $300,000, I used to tell people that that's the most they can sell their house for, because a buyer who needs to get a mortgage isn't likely going to be willing to come up with another $20,000 above appraised value if the house only appraises for $300,000. Well, lately, that's not necessarily true. It is crazy out there. I can have a listing that I can put out there, and I have offers that are 20, 30,000 above list price. And in the offer, it specifically states that the buyer is willing to come in with the difference between the appraised value and the contract price if the appraisal doesn't come in at the contract price. That is unheard of in my experience, but it's happening today. Well, typically that wouldn't be the case, and the sale would fail. With the seller financing contract, that's not true. A house is worth what a willing buyer and a willing seller agree it's worth, not a willing buyer and a willing seller and a willing appraiser. So if I sell my house for more money than a list price, I don't have to have an appraisal come in at that purchase price in order to finish the contract. And by the way, that extra $20,000 that I made or $30,000 that I made on selling a seller financing transaction, because it's been my primary residence for more than 2 years, 100% of that extra money is tax-free. Because as a homeowner, up to $500,000 of gain is tax-free if I'm married. Up to $250,000 of gain is tax-free if I'm single, filing separately. Well, that covers most houses. So that's another reason why we typically would sell, hey, you can sell a house on seller financing and you will get tax-free money because you'll be able to sell your house for more money. And I understand that in today's market, that's not necessarily the case. There are crazy people out there offering more than list price and are willing to come in with the extra cash in their down payment. But anyway, that's something to know about, is that's a big advantage for a seller who it's their primary residence. It's tax-free money, the difference between the sales price and what it would appraise for. So what is our objective in doing seller finance? Well, our objective is to generate more transactions and help more people. If we have buyers that come to us, the first thing we do is take them down to a lender. And when the lender turns to our buyer and say, I'm sorry, you don't qualify, what is the rest of the real estate world doing? I'm sorry, I can't help you. Come back in a year when you can qualify for a mortgage. Well, that's not my world. If I have a buyer that is an excellent buyer and the lender says, I'm sorry, you can't qualify, I find out why they can't qualify, how long it's going to take before they'll be qualified. And I said, okay, we can still buy you a house. We'll do it with seller financing. And I help people buy homes on seller financing. That's a major advantage for me as a realtor, because I can help more people. I can help make families have the opportunity to get into homes. They don't want to rent. They want to have a puppy. They want to be able to paint the house the color they want. They want to be able to make improvements to the home. They don't want to be a renter. They want to be a homeowner. Even though they may have to pay more for the house, or their payments might be more than a traditional loan, they know that it most of the time is only temporary. And they will eventually be able to get traditional financing and get those payments down. In the meantime, their house is going up in value. And so if they wait until they can qualify, how much more is that house going to be 2-3 years from now? Versus if they buy a house today on seller financing and maybe they pay 10% more today, but 3 years from now, the house is worth 30% more than it was today. And it still may be a financial benefit to them to do a seller financing transaction and pay a little bit more today than they would if they waited until they could buy a house and get a regular loan. So that's our purpose, is to help more people, generate more transactions. And so at this time, we're going to take a break. When we come back, Jax Petty is going to take the section and do seller financing from a legal point of view. But I'm going to pause and take care of any questions that have come up during the presentation so that I don't disappear with people wanting to ask me questions. So were there any questions on the things that we covered today?
Hey there, this is Brett Coulter. I do have a question.
Okay, Brett, go for it.
Yes, so my question is, it seems like contract for deed really is the way to go. What scenarios would an all-inclusive be better?
Well, an all-inclusive trust deed may be better for the buyer in that they're on title. And if they're not afraid of this, the underlying mortgage company calling the loan due and payable, that gives them a little bit more control of the property. It's easier to refinance an all-inclusive trust deed because I can go to any lender and they will look at that and they'll say, oh, you're on title, we can refinance it. So I don't have to just go with lenders who are familiar with seller financing and a contract for deed. I can go to the American First Credit Unions. I can go to Mountain America Credit Union. I can go to any lender and they will look at that transaction. They will see that I'm on title and they will have no problem refinancing it. It also means that if I do get into trouble, I have a little bit longer time to be able to resolve the issue because the seller has to foreclose. Now that's not an advantage for the seller, but that could be an advantage for the buyer because now I have, up to 4 or 5 months to get the problem resolved and get my contract back in made current. Where with the seller financing contract for deed, I don't have that opportunity. And Jackson's going to talk about the default remedies for each type of these contracts. But that's the only advantage to a buyer is that the contract is a little bit easier to refinance. Otherwise, a contract for deed is just as good. I have many contracts where I bought properties on a contract for deed, and I haven't had any problems with them in terms of me as a buyer being able to take advantage of home ownership or as a rental property. I rent them out, or as a landlord with a house that I bought on a seller financing contract. Any other questions?
Perfect. Thank you.
Hi, this is Kayla Watkins. I had 2 questions. First, are you representing both the seller and the buyer when you do these things? Sometimes you find the listing or you just somehow
Typically, you have 2 agents involved.
Okay.
You have a listing agent and a buyer's agent.
Perfect.
So
So then you would
very
normally charge the same
I'm
fees.
doing both. Most of the time, you have an agent representing the buyer and you have a separate agent representing the seller.
Okay. So then my second question is, with the all-inclusive trust deed, those ones do work out are the ones that are already owned by the person and there's no loan on it. And so those ones in those cases would be better to do the all-inclusive.
Yeah, if the house is owned free and clear and there's not an underlying mortgage, then you're just going to use a regular trust deed. The whole idea of an all-inclusive is it includes the fact that there are underlying mortgages
Okay.
that are included in the contract. So if I'm just selling a house that I have free and clear, I'm just like any other bank. I'm going to secure that with a trust deed and a note. Okay? Any
Thank
other
you.
questions? One thing that did come to my mind that I do want to bring up is one of the applications for this type of a contract are with people who are currently renting with an option to buy. I get a lot of this, and it's a tremendous benefit. If I've got a lease option right now, and I got into my house 3 years ago, and my option is about ready to expire, and I run down to the bank and I say, can I get a loan? I'm about ready to have my option expire. If I don't refinance that, what's going to happen to my option? I'm going to lose the house. And I've got a landlord that's just wringing their hands saying, oh boy, I hope they can't qualify. I hope they can't qualify. Because I've committed to sell this house on this option for $300,000. And now the house is worth $425,000. If my renter can't qualify, I get the house back. And by the way, my renter loses their option money. So if they put $20,000 down, they're going to lose their $20,000 down payment. I have a program where I have people come to me and I do a lease option rescue where I will buy the house and then I will turn around and sell it to the renter on a contract for deed for 30 years. So there are lots of things we can do to help people who are in various situations. This is one of my favorite, to do lease option rescues, where the option is expiring and the poor renter is saying, I'm going to lose my money. And the only option I have is to hand back the keys to my landlord, and he's going to sell the house, and I'm going to lose all that equity. Not to mention I have to find another place to live. So there's some tremendous things that we can do as realtors to help people if we have some of these tools in our toolbox. Okay, well, if there's no other questions, let's take a 10-minute break. And when we come back, I will introduce Jax Petty and get you started on the next section.
Thank you, Dave.
And frankly, if anybody has any questions during the break, I'm happy to field those questions too.
I have a question for you. As far as there's a home that's close to being paid off, the underlying mortgage isn't much, but there's a HELOC out on it. If we have in a seller finance addendum that they need to provide us with that information, and they don't, I mean, that puts them in default, right? But shouldn't title receive that information as well?
Absolutely. You need to know what every single underlying lien is on a property when you do a seller financing transaction. The buyer needs to be fully informed as to what underlying mortgages or liens are on the property. Now, sometimes it's not just a mortgage or a HELOC, it can be a tax lien. There's all sorts of things that can be on a property that once you understand what's there, you can still do a seller financing contract over the top. You just need to be aware that when I pay off my contract, there's enough money to clear all those liens off. But you never want to do a seller financing contract where the seller is hiding liens that they have and obligations that they have on the property, and they're hiding them from the buyer. That's nothing but a disaster for the potential buyer. They go to pay off their contract and the title company informs them, well, that's fine. You owe $300,000 on your contract, but we need $450,000 to clear off all the liens and judgments that are on the property. Now I'm in real trouble as the buyer. So absolutely, your buyer needs to have all liens and problems with the property fully disclosed. And that's why they need to get a policy of title insurance as well, is so that if other things come up later on, they've got a notice of interest that's been filed against the property at the county recorder's office that establishes their position in terms of ownership in the property. That answer your question?
Yeah, and if for some reason that information isn't received from the agent or whatnot, that would basically put them in default if we were to want to back out after a due diligence deadline.
Absolutely.
But that would give us the option to do so, right?
I would think so, yes. Especially if it's part of your due diligence deadline. And the seller financing addendum, there's language, there's paragraphs that deal with all that. You know, the buyer needs to provide information to the seller so that they can make an educated and responsible decision as to whether that's somebody that they feel comfortable with to extend credit to. The seller needs to provide information through a title company to the buyer as to what all the liens are. And if those things are unacceptable, both the buyer and the seller have the right to cancel the contract.
Does the seller have to pay off? Well, they don't have to pay off the underlying mortgage if it's almost completely paid off. They don't have to use the down payment money to.
No, they don't. They just have to disclose that it's there and what the payment is, and they have to make sure that when the buyer makes their payment to the escrow company, that the escrow company has all the information to make the underlying mortgage payment on time.
What about the HELOC?
That same thing with the HELOC. They have to be able to make the payment that's required by the HELOC. Now, most of the time, what we try to do is we try to freeze the HELOC so that they can't borrow any additional funds. But that's not necessarily, it doesn't have to be that. It's just that the seller is obligated to keep the escrow company informed as to what the minimum payment is for the HELOC. So a HELOC can be a little bit more tricky, but it's not something that will kill the transaction. You just need to make sure that you're making the minimum payment on the HELOC as well.
Sounds good. Thank you.
You're welcome. Any other questions?
I just wanted to comment on the HELOC. One of the critical things is you're going to want to have the buyer and seller sign something that releases you as the agents from any liability regarding the home equity line. Some title companies won't do seller financing if there's a HELOC in place, but as long as you have that release and indemnification, it's something that can be done. And I get it, not all title companies have attorneys to do that, but it is something that just with a little bit of preemptive precaution is doable.
Where could I find that wording, or would I just contact basically one of you guys?
You just have to find a brilliant real estate attorney that works in title. That's the only requirement.
And he's smiling right now.
Sounds good. Thank you.
John, do you happen to speak Spanish?
I do.
The golden language.
Seems to help out a lot in real estate today here.
Well, so we had somebody come to the class that spoke La Lengua Pura, and she, to this day, if you ask her, she claims to not really understand what she's doing. I would disagree with that, but she, some months now, will do 4 or 5 of these a month, because in certain communities, especially immigrant communities, they may not have a social security number, but they may have a very, very good income. And I've met some people that they do have that exact scenario. And the other thing that kind of precludes them from getting financing is they'll have actual mattress money, not just figurative. Dave, I know you've worked with Raquel on some of her clients. Do you mind accepting cash? Is that a problem for
No,
you?
I don't mind at all. I've been to a closing table where somebody bring in a briefcase and we sit there and count out $100 bills up to $30,000. I have no problem accepting cash.
I did 3 transactions with Raquel last year, Jax, at your office.
That's true. So John, if
Just personal ones, just where I was, yeah.
Go ahead, John.
Is there a limit to how much would be accepted in cash?
No.
There's not. We documented on the settlement statements as funds received by seller. And we'll sometimes have the seller and buyer document the cash, but there's not a limit.
And by
on
the
that.
way, as me accepting the cash, I take it down to my bank and I hand it to the bank and they go, okay, this is more than $10,000 in cash. We need to have you fill out this form. I don't mind filling out the form. So yeah, this is exactly where I got it. Here's the closing statement. I got $30,000 from a real estate transaction that I was involved in this afternoon. And the bank has no problem depositing that into my account. And so it's not an issue.
Documentation down the road, if the buyer tried to unwind that transaction, that there would be a cash acknowledgement receipt.
We've got a couple more minutes, but John, just to give you an idea, all she did was kind of go and speak to the people that run the little Spanish markets. And once she was able to successfully do the first one, and as you know, unfortunately, immigrant populations sometimes get taken advantage of, so they're a little wary. But once she was able to do a couple of those successfully, it was like the floodgates opened, and she had a whole new client stream.
I'm fully aware.
Yeah. We've got 1 minute left before we'll officially start. Does anyone have any other question we maybe haven't gone over yet?
Yes.
Jesse, go ahead.
I have a quick question. If we want to know a little bit more about it, the transaction and the coordination team like you and George. So if you guys put your information on the screen or email to us, that would be helpful.
That is a great point. We will finish up this with that up on the screen. We'll have to make sure that George's is correct. Apparently there was one part that wasn't on his, but we can go over that, and then we can email it out as well.
Yeah, that's fine.
Okay.
Okay, are we back from the break? Is everybody here? So we'll assume that everybody's ready to go. We've got another 90 minutes to go here. And the next section is an important section because we're talking about the legality of seller financing. Now, when I first started real estate as a brand new agent, we did seller financing transactions. We called it creative financing. And any broker right now would cringe at the idea of their agents being involved in being creative about their financing. We have limits as to how creative we can be as agents. We have to make sure that we're not acting as attorneys. And so we want to make sure that everything we do is within the legal aspects of what we can write up in a contract. So we want a financing addendum, and we might want to definitely make sure that the transaction is closed to the title company and that the final documents are prepared by attorneys. Those are crucial to protect you and your broker from any lawsuits later on down the road. And seller financing, a lot of times, these have a tendency to go south, and people are not very happy. If they're not done correctly, they can make a lot of bitter enemies of people who are losing money. I had the Division of Real Estate talk to me about the fact that they didn't like seller financing transaction. I asked them, I said, why don't you like them? And they said, because people lose money. The buyers are being taken advantage of. And I said, wait a minute. I said, do you have any problem with lease options? Well, of course not. Well, if somebody puts $30,000 down on a lease option and 3 years later their option is over, are they going to lose money? I said, well, of course they are. I said, well, then why are you upset about that? If somebody buys a house with Chase Mortgage and they get a mortgage and they put $30,000 down and they don't make their house payments, are they going to lose money if the mortgage company forecloses on them? Well, of course you are. Well, why aren't you upset about that? The fact of the matter is seller financing is no different than any other transaction. If you meet the terms of the contract, you're not going to lose money. And so it's important that the terms of the contract are are done by legal attorneys so that buyers and sellers are both protected. And there's nobody better at this than Jax Petty at First Liberty Title. I've been working with First Liberty Title since the early 80s. Now, Jax was still in law school. I worked with his dad, but he came in and he's taken over the title. And now I worked with Jax exclusively. And they know their stuff. The title company will help you with the legal questions. They will help you fine tooth your contracts if you need to have it done. So it's a critical thing to work with the title company that knows seller financing backwards and forwards. And so for the next hour and a half, I'm happy to let you take off and work with Jax and ask him questions, and he will inform you on the legal side of the seller financing contract. So Jax, it's all yours.
Thank you, Dave. We've had some great questions already, and I'm going to suggest that it would be worth your while to get a pad and paper on some of the things that we're going to discuss. We've actually taught some of these principles where we do investor seminars and charge quite a bit of money to do that, and it's going to be free for you today. So I would take advantage of that. So the first thing we're going to start talking about is kind of some of the things we're going to go over. We'll be going over the theory, but we also want to go over the practice, because at the end of the day, if you don't know how to monetize this information, it's not going to be as valuable to you. So I'll go over the things that you need to know to stay out of trouble. But also we're going to go over some of the systemization that agents have used to really be successful, regardless of the market when it comes to this. So when I submitted this to the state as far as getting approval, I came up with a few different titles for it. The first one, for some reason, they didn't like. They didn't like the banks. We don't need no stinking banks title. I don't know if any of you have ever seen Blazing Saddles. Probably a little too irreverent for your movie viewing, but the other reason I didn't use that is quite simply, as I hope you understand by now, you do need to have a lender that understands this, that can tell you a couple of things. And my underwriting guidelines for helping agents do seller financing transactions come down to two rules. Is it legal and is it ethical? Or to broaden that out, is it going to affect licensing or liability? And so when you have a lender that said these people should be able to qualify within 3 years, it takes that liability off you as the agent. And again, you can make a lot of money and help a lot of people using these techniques, especially in high-end properties. And I'll go touch on that a little more later on. But you also need to understand how to safeguard yourself in this and any transaction. So how would you teach this is kind of how I want you to take notes on this. If you look at the learning pyramid, if you will, if all you do for the remaining hour and some odd minutes is listen to me, you'll probably get more than my kids would out of it, but still probably in the 7% range. But if you're actually in the, how am I going to teach this to sellers, buyers, and other agents, and that's how you're coming at it, you're going to be closer to the 10%, 90%, excuse me, range. And that's really what I'd like to see, because you're going to be spending the time either way. You might as well learn those things. I'm going to ask you to write some things down now. The first one you've probably heard before, but I'm going to give you a clue as to how to tell if you're crossing the line. So, if we were in class, I'd ask you all to raise your hand if you've heard "don't give legal advice" before. And, I would assume, unless you've lived in a bubble and somehow did your coursework online, you've heard that. But in giving these classes, I will ask over and over again, now please raise your hand if you can legally define the difference between sharing your expertise and giving legal advice. And very rarely, if ever, will I get somebody even attempt that answer to that question. And so to me as an attorney, and again, my big thing is licensing and liability, it kind of terrifies me that agents are told what to do when it comes to legal advice or what not to do, but not what the difference is. And that's why you see agents sometimes getting in trouble with that. The difference is this, if you want to write it down. If you tell someone what to do, you've given legal advice. And I'll repeat that. If you tell somebody what to do, you've given them legal advice. And whether it's correct or not can still cause problems for you if you're not a licensed attorney. So you'll want to use things that sound like semantics, but it's actually very important. In my experience, most buyers would order a home inspection, or, you know, based on what the comps have come in at, this would be a price you could sell your house fairly quickly. This would be one where it may sit on the market for this long. But at the end of the day, it's your, you know, Mr. Seller, Mrs. Seller, your responsibility to select what the listing price will be. If you say you will list your house, this is what we're going to list your house at, especially in a market like this where it could be worth significantly more, that can cause some issues. So just keep that in mind. Now, the second one you may have heard about, Dodd-Frank, and these are some new regulations, not new any longer, but for actually a year, Dodd-Frank made it so that all seller financing transactions had to be 30 years. Luckily, they revised that when the Consumer Finance Protection Bureau put in their regulations. And I know this part isn't the most exciting, but to get core credit, we do need to go through kind of the history when it comes to a statutory analysis of seller financing. So as of 2014 through present, you can do a seller financing transaction that's less than 30 years, but they do have an issue with negatively amortizing seller financing transactions. So now that we've got that out of the way, let's talk about CFPB TRID compliance. I'll get this question for people that have kind of studied this issue. Thankfully, seller financing transactions are not under TRID. You don't have to do CDs with multiple disclosures days before. You can sign up or come to close and you will just sign a settlement statement. That taken care of, let's talk about something that will be important to you. Very often I will get calls from agents or their brokers saying, okay, we've got a transaction that we want to do as a seller financing transaction. We don't want to make any mistakes. And that's a very wise thing to do. And oftentimes I'll review those contracts for them prior to execution. But what I'd like to do with you is go through the seller financing addendum a little bit. And we're going to start with Section 1 credit documents. Now, if you go through past iterations of the real estate purchase contract, you will find that they used to have many more options than simply note and deed of trust and all-inclusive note and deed of trust. They would have up to 5 or 6 options, and then now they've combined all of those into the other category. So for example, if you were doing a contract for deed transaction, you would select other and write in contract for deed. So that's going to be the first keyword for this section, is going to be other. I'll repeat that again. The first keyword for this section will be other. Now on credit terms, I've seen all sorts of creative things put in. And so sometimes people complicate it. They think it's advanced calculus when it's really just simple math. The first blank where it says, has a dollar amount or dollar symbol, then a line, then principal. That is where you're putting the amount that's being financed. And the math on this is really simple. Purchase price minus down payment is the amount that's being financed. I'll tell you some of the common issues I see when people do these. One of the main issues I see is they'll change the down payment, but they will not change the other terms regarding that. They'll think that just changing the down payment changes the loan amount. It does not. You'll have an internally conflicting contract. So what you'll want to do is, if you make a change, sales price, that doesn't change the amount that's financed. If you change, just say the down payment will be this, you've got to delineate whether it's going to be a change in the sales price or a change in the amount financed. And then you always want to put in the new principal and interest payment amount, which if you look, here's the interest rate and here's the principal and interest. So that payable at approximately is just going to be the principal and interest portion. I can't tell you how many times I see where they're like, oh, well, we need a payment of $2,400 to cover taxes and insurance. And they'll put $2,400 in that amount, not realizing that Section 3 always adds on taxes and insurance to the payment. The next section is per, and that's going to be either months or years. On the residential side, I've never seen anything but months used, but sometimes in commercial, they will put an annual payment. And then due in X amount of months. This is where you would designate the balloon payment date. Obviously, the buyers want a longer payment term. The sellers want typically a shorter payment term, unless they're trying to maximize the amount they're earning off the transaction. There was a question in the chat earlier about what percentage does the seller earn? And, you know, in reality, the bigger the underlying loan, the smaller the interest rate, and the less that the seller has in equity, the more the seller's going to earn. Now that may sound like it's a foreign language, but if you have questions on that, Dave is an excellent resource. He's got a spreadsheet where you can plug in the interest rate and those types of things and show the seller how much they're making month to month. And it's interesting from our standpoint, from the title company side, we'll have sellers that are very reticent to enter into the transaction. But then when we contact them to say they're getting paid off, they'll actually tell us that no, they don't want the buyer to pay it off, because they take their, you know, $50,000 in equity and put it in the bank, they're no longer making a substantial return. They're just making, you know, close to zero on it. So don't be surprised if one of the things that sellers that do this come back to you and say is, I'd like to do another one. And we have several agents that work with investors that will buy any property and sell it to a seller finance buyer, because the buyer has a large down payment and the rate that the seller is getting on their investment loan is significantly less than what the buyer is paying them. And it can be a great resource for agents to put those deals together. And then first payment due will always be, you know, in the future, because if you remember, interest accrues. It's not like rent where it's paid at the beginning of the month. It has to accrue. All right, let's talk about another thing that trips agents up. And I know that everyone on this call reads all of their contracts. You probably have them memorized. But believe it or not, this may shock you to know, a lot of other agents don't read their contracts, and even the ones they're getting offers on. In fact, I had an agent that started doing seller finance and was doing a lot of deals as a buyer's agent. But one of the things that down in Section 5 it talks about that we'll get to is the default rate. And the default rate is supposed to punish the late payor, but they would always put 3%. So on half their contracts, if the buyer defaulted, the interest rate actually went down, and only one agent caught it, and that's because they made an offer on one of Dave's properties. But Section 3 automatically adds property taxes, homeowners insurance, special assessments, and hazard insurance. So all of those, since the buyer is now the owner, are going to be added to that principal and interest payment. So just be aware of that. Now, Section 6, the due on sale clause, is one that I like because it limits your liability as an agent. You want something signed by the buyer and the seller indicating that they acknowledge there may be a due on sale clause if there's an underlying loan. And so both of them will sign this document, but it also asks for the seller to provide the buyer a copy of the underlying loan. which can be very important, especially if it's a second mortgage or a second mortgage home equity line. Now, let's, mouse, there we go. If we go to section 4, this one talks about the escrow company. Now, please write this down. If you're doing it for clients, use an escrow company. Unless you enjoy phone calls at the end of the year from a seller saying, will you calculate my 1098 interest for me? It's just a headache relief for you, and frankly, for the sellers and buyers as well. Now, I get it. As an investor, I'll go in and I may not use an escrow company because I'll usually just buy out the seller's equity, leave their loan in place, and make payments directly to their mortgage company. But again, I've done this before. I know what I'm doing. If you're doing it for a client, I would strongly suggest you always use an escrow company. Now, there are 2 escrow companies in the state of Utah. I'm not going to, well, so one is Escrow Specialist, one is Elite Contract Services. We've been having significant issues with one to the point where we will not set them up for clients anymore with that company. So if you want to write down the company that I like, and that I know Dave and George, who do a lot of this, like, it's Elite Contract Services. And I'm not advertising for them. I'm just telling you from a practice point of view, we've seen a lot of issues with some other companies lately. All right. And then that can be split actually between the buyer and seller as far as the setup and monthly fee. As you can imagine, when I'm doing it as an investor and I'm going to be using that, I'll have my buyers pay for that fee because it's in my opinion, a great thing for the buyer to use that and make sure their underlying loan's going to get paid. But as a buyer, if I need to use it, I'll try to get that seller to pay for that. But again, usually we'll see that split evenly between the parties. Now, the late payment, let's talk about that for a minute. This is going to depend heavily if you're on the buyer's side or the seller's side. Typically, almost always, it's the buyer's agent that's writing this contract. So you'll see, sometimes they'll put 15 days and a $50 late fee, and then the same default interest rate as the rate that's mentioned in section 2. Now, as a title company or an attorney, I'm not too concerned about that except for one thing. And again, if you're thinking of ever doing this, I would write this down. If there is an underlying loan, do not go beyond 5 days on the grace period. Even if we're the buyer's agent, Mr. Petty, yes. Even if you're the buyer's agent. Here's what I've seen happen. If we were in a class, I'm sure you could all as agents answer what the lender is going to put as a grace period. They're going to put 15 days. So what if you put 15 days as a grace period, your buyer pays on the 14th, the seller's going to definitely have a late fee on their loan, because by the time the escrow company turns it around and gets it to the mortgage company, it's now beyond that 15-day grace period. Now, I don't care who you are, angry sellers are a bad, bad thing. And especially if it gets to the end of the contract and that buyer needs just, one more week and they're able to close, and they've got to get that extension from the seller, and the seller's been dinged with late fees the whole time, it's not a good scenario. So if there's no underlying loan, feel free to put what you would like. But as a practical point, if there is an underlying loan, I would suggest not going beyond 5 days on the grace period. Now, as a seller investor, I will put fairly strong penalties in on a counteroffer and a fairly significant default rate. But again, that's just part of the negotiation depending on which side you're on. We talked about due on sale. Sections 7, 8, and 10 are about buyer's disclosures. There is no legal requirement to give the seller any information from the buyer. But sections 7, 8, and 10 actually tell you to do that as a contractual requirement. Now, let me tell you a little backstory. I was asked to go to testify before the Real Estate Commission on seller financing and some of the issues that this form had. One of the primary ones is that it did not have an addendum number, which in litigation can be a huge issue. So they did change that. One of the things they didn't change that I see as a huge potential problem for agents, and again, I'm looking out for your licensing and liability in this, it has to do with section 7, 8, and 10. So let me give you this scenario. Imagine you are the buyer's agent, okay? You send this offer to my agent, who then sends it to me. I sign it, and then I request all the buyer's disclosures. So what it's basically asking for is for you to send me everything that I could possibly need as a seller to steal that buyer's identity. Does anyone see a problem yet? Does anyone see the huge liability trap that creates? Because if your buyer sends it to you, maybe they fax it to you. Maybe they're a little ancient on their technology, and then you fax it because it's already in a fax. You're standing by the fax machine. You fax it to my agent's office. Now, it could have been viewed by countless eyes, and then it finally makes it to a seller that you and your buyer have never met. I ask this question in class every time. I say, if that scenario occurs and somebody steals the buyer's identity, who gets sued? Now, I can see some of you on the screen. Please raise your hand if you think you would get sued under that fax pattern. Excellent. Everyone I could see did raise their hand. So 100% on those that I can see. That is absolutely correct. And unfortunately, as agents and as attorneys and as title companies, we have a huge target, which is called E&O insurance. Because for the E&O, it's cheaper to write a $10,000 or $15,000 or even $20,000 check than it is to litigate something where how do you prove as an agent that you didn't let that information out to someone? So if you're taking notes, I'll give you the key to deleting that issue as far as liability. Put a clause in the Rep C, and you can put it right in that first page in section 2 on the seller financing addendum. Put in a clause that says, all required disclosures under section 7, 8, and 10 of the seller financing addendum shall be given to lender X at company Y, and then include their contact information, who shall provide a detailed analysis thereof. Now, I'm not expecting you to write that down. We're going to put my email address up at the end. If you send me an email saying, I would like that clause, or, hey, I'm working on a contract, this is what we would like to say, what's the correct phrasing, I'm happy to help with those. Even if I'm not going to be the one closing it, I would rather see it done right than have it brought to me in the future as an expert witness trying to get you out of trouble. So for what it's worth, that's a resource I think that's very valuable. Now, section 9, title insurance. This is the last one on the seller financing addendum that could potentially cause you liability. So I'm going to touch on it as well. Here's the fact pattern, right? You as an agent, you're representing the seller, and they have a paid off property, $500,000 property. And they're like, hey, I've got really no need to invest this. I'm living in my house in St. George. This is my Salt Lake house. I'm going to make a lot more return, guaranteed and secured by real property, selling this seller finance than I am pulling it out and putting it in the bank. Or, anyone who doesn't think the stock market is due for a correction right now, I'm honest, so I won't take your money, but I'm sure there's plenty of people that would love to help you lose your money in the stock market or otherwise. So they're like, I would like to sell it seller financing. And then you get an offer that on section 9 says that the buyer shall not provide the seller a lender's policy of title insurance. And the seller turns to you and says, is that a problem? And you say, no, nothing ever happens with title. Don't worry about it. Who just insured their title? Raise your hand if you think it was you and your brokerage. Yep, I see one correct answer. John? Yeah, I can see you. So yes, you just insured their title to the tune of $500,000 because their owner's policy is gone because they sold the property. And the title insurance for the buyer, which is the owner's policy, is going to cover the buyer's loss. So if the buyer's put down $25,000, here's a check for $25,000, right? So So be careful on that as well if you're on the listing side. So let's talk about how to resell a seller finance property. Now, this is something that we as investors or investors that you might want to work with do quite often. And this is how that one gentleman I mentioned that had made 1.7 million net in a few years has really generated most of his wealth. He'll buy a property on seller finance, and then he'll sell it on seller finance. Now, why does that make sense? Let's say you have $30,000 that you can invest, right? That's not enough to buy a house, but it is enough to buy a seller finance property. So he'll find a property and he'll go and buy it. And me, myself, my goal is always to get in with as little as possible on the seller financing transaction. But what do I want from my buyer when I sell it? Well, if I can get in for 30 and I've got a buyer that's bringing in 60, and by the way, I've had 2 phone calls in the past 60 days from agents saying, hey, I've got a buyer, and the minimum amount they told me was with $60,000 down. So if you're an agent sitting there and you're like, oh, we've got access to a little bit of money, you can do this. You can buy it on seller finance, and then you can sell it on seller finance. It qualifies as a legal transaction because you are funding both purchase and sale. That is a requirement in Utah. We used to have, way back in the day, like 90s, early 2000s, you could do a straight arbitrage where you'd buy and sell a property and use the end buyer's money to fund your purchase. You'd never put any money in. That's not allowed. And if you have questions on this afterwards, please send me an email and we can go into more detail. But if you take your $30,000 and you buy it on an all-inclusive trustee to note, you can now sell it on an all-inclusive trustee to note, or you can sell it on a contract for deed. Now, I love the question, and I forget the gentleman that asked. He said, it seems like the contract for deed is the way to go. And the answer is, it depends. I don't have a preference on which one I use if I'm neutral as the title person, but I do have a preference if I'm a buyer or seller. And this is my rule of thumb. If it's not FHA, I try to buy on an all-inclusive. Now, let me just tell you, if it is a Utah housing property, they will aggressively pursue the due on sale clause. So I will not allow my office to close an all-inclusive over an FHA financing transaction, and you shouldn't try to do one either. We always do a contract for deed. And I'm kind of, I wouldn't say apprehensive by personality or pessimistic by personality, but definitely by training. And so I actually spent 3 weeks getting a hold of the director for one of the FHA regional offices, the vice director, and their head legal counsel. We had them on a conference call. And I asked, if you do an all-inclusive over an FHA transaction, can you be prohibited from doing FHA closings? They said yes. I said, what about a contract sale? They said, you mean like a contract for deed? I said, yes, exactly. They said, no, it is a violation of the due on sale clause, but it will not get you put on the limited participation list, or if you want to simplify it, the FHA naughty list. So again, with the exception of an FHA or a grant program like Utah Housing, I will always try to buy on an all-inclusive because that gives me the strongest position. In a few slides, we're going to go over the secret sauce, or the most valuable part of this entire training, which hopefully you'll take advantage and write those things down when we get there. But you'll see why I want to buy on an all-inclusive. But when you buy on an all-inclusive, you can sell all-inclusive, or you can sell contract for deed. I like to sell on a contract for deed because if the buyer defaults, I only have a 30-day forfeiture process until I can then take back the property and resell it. And by the way, when a buyer defaults, if it was set up correctly, it's like winning the lottery for the seller. I actually have a client, they had a property up on Wasatch Boulevard. They sold 3 times and paid the property off. So the agent loved selling it 3 times. We didn't mind closing it 3 times, but he actually called me and he said, you know what, I think this property is cursed. And I said, cursed? Man, that thing is the golden piggy bank. Maybe I'll buy it from you and try a few times. The next thing is that on an all-inclusive, it's similar to a traditional transaction. And when it's paid off, you're going to have a separate payoff for the seller financing. So on the settlement statement, it will show the payoff to the underlying loan and then a payoff to the escrow company. Now, in a contract for deed, if you buy it with a contract for deed, you can sell it on seller financing contract for deed, but you could not do an all-inclusive. And here are some things that you want to put in your agent remarks when you sell a contract for deed sale. And I get this call all the time. It'll be some poor title company that doesn't have an attorney on staff, and they'll say, we're trying to close this. We don't know what to do. Can you tell us what to do? And they can't see me smile through the phone, but I just, I say, you know what? I completely understand your dilemma, but also understand I am not going to give your title company legal advice. I'm not your attorney. So you're going to have to go and figure that one out. But in the agent remarks for you, it's really easy. Here are the things you need to include. Number one, seller acquired their ownership via a contract for deed purchase. And again, if you want to email me afterwards, I can send you this to use. If you find a listing that the buyer bought it on contract and now they're listing it through you to sell, but you want to put that in so that you don't get crazy phone calls from agents saying, hey, this person isn't on title, they don't own it. That is actually completely incorrect. They do own it because Utah recognizes the equitable conversion that makes them the owner. Just like you own your car, as George mentioned, even though you may not hold the title to the car, the bank does. Same thing here. Lender, in this case, the seller is holding the title. Ownership did transfer to the buyer. Second thing you want to put in is that it's required that the buyer speak to, and then you put in somebody that you know is an expert at refinancing or financing seller finance transactions. The reason you do that is you're not a lender generally. If you are, great. This is something you can add to your repertoire. But if you're not, you want a lender to explain to that buyer that this is perfectly possible and legal and there's no issues doing it. Because then if they stumble into, someone that doesn't know what to do with it, they have a resource that can help them. And then the third thing is you want to make sure that they close at a title company that understands these transactions. So here comes the part I referenced earlier. This, out of everything we've gone over, is going to be the most critical part to understand this. I will have, in fact, I had somebody call on a multi-million-dollar property in Park City, and the buyer was putting $350,000 down. And the seller wanted, their attorney on the line, which I actually really appreciate when there are other attorneys involved in those big transactions, because usually it's much easier. So it was their attorney, the seller, me, and I just answered their questions. And this is the foundation that I used to go through and answer their questions. And at the end, the seller was not only fine with it, he was actually happy to do so, and had some other properties that he was going to let the listing agent list under seller financing. So let's go through that foundation. And if we were in class, I would verbally ask the question it asks on the screen. What are the different types of seller financing typically used? And what are their default remedies? Well, that's what we're going to go through. Now, if you do have a scratch paper, write this on it, just like it is on this page. Strong for, months, legal, and down payment. And then on the side, we're going to put down the different types of seller financing. The first one we're going to go over is the lease option. And it's interesting that sometimes people don't recognize a lease option as a seller financing vehicle. It actually is. People that don't understand seller financing will use seller financing and all-inclusive trust deed synonymously. And while all-inclusive trust deed is a type of seller financing, hopefully by now you've realized it's not the only one. So we're going to go over who is it strong for, how many months does the default process take, what are the legal costs involved with the default process, and what we typically see as a down payment. Now, everything regarding the seller's decision on this should be based on risk. I get it, you're dealing with humans, that's sometimes emotional as well. But if we can quantify it to the risk, it actually is much easier for them to understand. And the down payment is what covers the seller's risk. So when we're talking about a lease option and a contract for deed and an all-inclusive, we're going to always start out with who is it strong for? And a lease option, if you want to write this down, is strong for the seller. It's strong for the seller because imagine this scenario. Think about the place you live right now if you own your home or your condo. What if you were 1 day late on the rent and all of a sudden you no longer have any ownership interest and you're getting a 5-day eviction notice and you've got to be out of that property in 5 days? That's not a very strong situation. In Utah, our laws are also pro-business. So the entire eviction process, even if it has to go through a court proceeding, will usually be wrapped up in a very short amount of time. I put 2 months because, sometimes it takes them a little bit to file it. Sometimes there are extenuating circumstances. Sometimes they claim COVID. You don't know. But plan on about 2 months for a standard eviction. The legal costs are fairly inexpensive, and this is going to be the minimum cost, right? So don't take that as the maximum. The minimum cost is going to be about $500. And typically what we see is a $5,000-ish, maybe $10,000 down payment. Here's the problem I have with that. I have sold properties on lease options. But the only time I've personally done it is when I bought the property from the individuals and now I'm selling it back to them. Because if they've essentially put a huge down payment down in the form of their remaining equity. But for me, $5,000 doesn't cover the risk involved with anything. I mean, if you're renting your property and somebody breaks in, you still have to do an eviction, or excuse me, renting your property and they don't leave, you still have to do an eviction. But if they damage the property, that can get much more expensive than $5,000 fairly quickly. The next one we're going to talk about is the other end of the spectrum. The all-inclusive trust deed is strong for the buyer. And if you're a buyer, you want the strongest position. The reason it's strong is it takes up to 7 months between the 4-month, and please write that down if you're taking notes. The foreclosure is a 4-month process. It's not 7 months, but then you have to add potential delays, issues, the grace period in, and the eviction at the end. So that's how it can get up to 7 months fairly easily. Now, I have seen some offers come in where somebody wants to do an all-inclusive with $10,000 down or $20,000 down. And if your buyer's payment is $2,000 a month, that's $14,000 your seller's going to have to pay while the buyer's not making a payment just to get them completely out of the property. So that's why you typically should get and do see a much higher down payment. The legal costs are also higher when it comes to an eviction and foreclosure. You're talking 5 times as much as a minimum, but you're usually seeing a much bigger down payment. When would you use an all-inclusive as a seller? When the buyer has a down payment that justifies giving them an all-inclusive deed of trust. By the way, on that $350,000 down payment on the multi-million-dollar Park City property, they actually did that as a contract for deed. I would have thought that was enough to get title and do an all-inclusive, but in their negotiations, that's what they settled on. Now let's talk about the contract for deed. And you may hear this referred to as a land purchase agreement, a bond for deed, but in the guidelines, it's most typically referred to as a contract for deed. So that's the document set that I use. It can be strong for both. And the reason for that is this. The other two are controlled by statute. You cannot do a foreclosure in less time than the statute requires. Actually, one of the best properties values I've ever picked up was because the seller had it paid off closed on an all-inclusive somewhere else. The buyer defaulted and the seller went to an attorney, and I did use air quotes. You saw that. I'm not sure if it was, mail order law school. I don't know. I'm not judging. But the attorney had done a foreclosure in 2 weeks. Now, you can't even do the initial 90-day redemption period of a foreclosure process, obviously, in 2 weeks. So now he created a scenario where nobody legally had the ability to sell the home. Well, I knew how to fix that. So instead of paying $350,000 for that property, I paid under $60,000 for that property. But again, that's because they messed up the foreclosure timeline. You can't jump over state statute, but with the contract for deed, it's the only one where the contract can dictate kind of what that timeline is going to be with a minimum 30-day period. But I've seen where realtors have bought their own properties and they've put a 6-month forfeiture period. Can you do that? Yes, you can, because it's a contract and parties can negotiate a contract. So the minimum amount, though, the one that's typically used is the 30-day forfeiture process. Now, if we were in the physical class, if I had the pleasure of seeing all of you personally, I would ask one of you first I would ask if any one of you took a college level math class, and we'd usually get like 7 hands that start to go up, but only 3 that make it because they're a little nervous. And I would ask one of them to tell me the difference between those 2 numbers. And believe it or not, only one person has ever got it wrong, but they did actually get it wrong. But for those of you that know any math at all, the difference is one month, right? Here's why the majority of people and investors that were using lease option systems switched to contract for deed sale systems, because it's 30 days more risk. And what do you get for 30 days more risk? Well, you get a slightly more expensive forfeiture process, but you're getting 10 to 20% down payment. So instead of $5,000 or even 10, you're getting 10 to 20% down. And for 30 days risk, we're talking 30 days more risk than renting a property out. You're getting a huge amount down. And that's why you or an investor can go in and buy a property and sell that property on seller finance, make all of your investment back plus some. So now you've got an infinite return because you have no money left in the property. And then by doing that, you're making the premium difference between the mortgage interest rate and the interest rate that you're charging the end buyer. And I'll often get asked, what interest rate does that end buyer get? Well, typically it's obviously going to be more than the market rate. So right now I'm seeing things in about the 5.5%, 6% range. That's a pretty good return for the person that's getting that difference. So honestly, we'll see a lot now where the bank is earning less on their money than the seller finance seller is, which is kind of a nice thing. All right, so let's talk about what types of transactions can you use seller financing in? Because sometimes I'll hear, well, you could only use it for this type of transaction. And let's start with residential. That's the one, obviously, because there's more residential transactions that we see used the most. But you can also use this in raw land. I helped put together a development in Utah County. The initial purchase price was $5 million. The buyers only brought in $2 million. They put everything else, no interest payments. They put everything else that when each lot was sold, the seller would get an amount paid to them out of the sale proceeds. So think about that for a minute. These people, instead of coming up with $5 million or financing it through a bank that they're going to have to make monthly payments, they financed it directly with the seller. So now, if the economy tanks, they're not getting killed by an interest payment that they end up losing the project. They just wait until the lots would sell for a price that makes sense. And that's what they did. So raw land can be used. So if you're thinking about getting into development, It is a great tool. In fact, most of the commercial buildings that I've purchased in my time have been on seller financing. And so what about commercial? Well, commercial seller financing is used quite often. In fact, 3 months ago, I got a call from an agent that I work with. He has a seller that's selling 5 hotels on seller financing. And, you know, he's just tired of running them, but he wants to still make money plus get a big chunk down. So there's really not a type of real estate that you can't use it on. Now, I'll briefly say this. You can use it on personal property as well. You can do it on motorhomes, boats, automobiles, but we're going to stick to just the real property applications. All right, so we've burrowed down and we've figured out what it is you need to know as agents so that you can have an intelligent conversation with anyone regarding seller financing. And it's what we just went over. So now we're going to go to the 10,000 foot level. We're going to say, in order to have a successful transaction, what do you need to have? And the first thing you need to make sure you're doing correctly is you're customizing your contracts. And again, if we were doing an in-person class, I would give you some fact scenarios and have you raise your hand. So we'll try to do that over Zoom. Raise your hand if you think this would be the correct document to use. So, buyer has $5,000 down. It's a $400,000 property using an all-inclusive deed of trust and note if you're doing the listing. Raise your hand if you think that's a good idea. All right, I only saw one hand. So the rest of you got it right. I'm not going to tell you who raised their hand, but that would be a bad idea because $5,000 down does not cover the seller's liability to do an all-inclusive. It might be enough for a lease option, but on that scenario, we would expect, you know, 50, 60 or more $1,000 being put down to do an all-inclusive on a $400,000 house. And by the way, people have money. It's always interesting to me to see how much money people have to put down on seller financing. And a lot of the bigger deals we do, it's business people that have access to enough money they could just write a check for the property, but they want to keep that money working in their business. So they will do seller financing purchases on that, you know, $1 or $2 million house. Second thing is correctly educate the parties. Make sure your buyers and sellers understand the benefits and the risks. And, you know, we just went over what you would need to educate them. Third one is, often if you're working with buyers, you're going to want to work with a lender or a company that can fix their credit. I can't tell you how many times, in fact, you're going to see, this is what's going to happen. One of the reasons I'm excited, if I should be, for the downturn that's coming. You had COVID hit. You had a lot of very successful businesses that were entertainment based where people were making huge amounts of money that now they're making nothing. And so they may lose their credit rating. They may lose a bunch of things, but they have this skill. They know how to make that money. And we see this quite often. Before, it was typically when somebody was doing really well and they had a medical event. And now they've recovered from the medical event and they're earning a bunch of money again, but they can't go to a bank and get a loan, but they've got the money, right? They may have $50,000 to $100,000 to put down and enough to make a very nice monthly payment. But you're going to see a bunch of rebound COVID clients. Now, imagine you as an agent had the ability after this class to talk to every one of those people, right? Think of the number of closings you would be able to do, because you just take the percentages, how many people were affected by COVID in the state of Utah, and you're going to have about a third of those that they're genetically programmed not to pay a bill anyway, so they're not there. But the other 2/3 are potential clients for you. So how are you going to find those clients as the economy recovers and they start making a lot of money again? And then the other point is indemnify, indemnify, indemnify. So I always have the buyers and sellers sign an indemnification that says, we, the title company, you, the agents, your brokers, we're not their attorneys, we're not their accountants, we're not, doing anything else than our limited scope role within these transactions, and then close the transaction. There's really no reason to wait once the due diligence is done and different things. In fact, it surprises me how often I'll call agents. I called one last week. I said, hey, everything's ready to close on this. What are we waiting for? I don't know. I'll call the other agent. Oh, they talked to the other agent. I thought that they were waiting on, a phone call or an email, and no, they're ready to go. And so we'll close the transaction. It's like the anti-short sale closing. But really, get everything done and close it. There's no reason to wait on a seller financing transaction. All right. So I promised you the theory and also the practice. The practice part where you actually make money is what we're going to go over now. One of the things that I like to do, and hopefully there's somebody in this group, there's someone that is actually going to add it to what they're doing. And, I'll see people go out and they'll close 4 or 5 transactions in 60 days on seller financing because they just get the word out to their sphere of influence and different people, and they'll start closing those. And so I'll call and ask them, I'll say, how are you finding success? It was interesting when we were doing these transactions back in 08, 09, 2010, we were killing it. We were having fun, but all these other agents were having to get second jobs or even getting out of real estate. And we felt bad for them, which is one of the reasons that we like teaching this class. But as more people understood it, the Salt Lake real estate scene started working again because it wasn't just bank dependent when the banks were nervous. So if you want, you can go ahead and write down the 3 circles with the line through the middle on your notes, and we'll use that format. But the first thing most people start with is buyers. And the reason for that is buyers know they need seller financing. They've already been told by a lender that they're not going to be able to get a loan, no matter how much money they have to put down because of their credit or something else. And one of the most ridiculous reasons I've ever heard was, this was another high-end property. The guy showed on his taxes 2 years ago, $1.2 million in income. Well, he did some better accounting. So last year he showed $850,000 in income, and he owned the company. So he was technically self-employed. Well, guess what? The lenders wouldn't lend to him because he had decreasing income. He only needed $400,000 in income to get the loan. So sometimes it's not that the buyer has bad credit. It may be that they just bought a business and they can't use that income to qualify for 2 years. You never know, but buyers are typically where people will start. So let's talk about how you could get people into your buyer pool. You don't have to write these down, but they may become very valuable to you if banks get nervous because the stock market just crashed. And now you have clients that want to buy and sell, but the banks aren't comfortable with that. So my favorite way is this: lending partners, right? I want each one of you to think about your favorite lender or lenders you've worked with. How many times have they consistently given you clients? George, you're still on, because I'll send you some clients once in a while. How many clients have I sent to you maybe in the past year?
Oh, at least a dozen.
And how many clients have you sent to agents in the past year?
Probably close to that.
Okay, and that's just one lender, right? So
Can I just
what?
ask, have we missed a keyword? I think we've just got 2, right?
No, there was a third.
Oh, a few of us missed it then.
Okay, it was other.
Okay. Thank you.
You bet. All right. While we're pausing for keywords, Leslie Ann, let's do another one. Let's do pool. Pool.
Thank you.
You are welcome. So I work with Chase, and I happen to track their statistics because I have access to their branch managers. the typical Chase branch, this is just one branch of a bank that's in Utah, will have 30 people come in wanting to buy a home. A third of those will not qualify and don't have a down payment. A third of them won't qualify, but they do have a down payment. And then a third, Chase can give them a loan. So I want you to just in your heads calculate, if you had one Chase branch sending you all those people that don't currently qualify but have a down payment, what would your bottom line have been like last year? 1 year, 10 people a month that you're doing closings for. And so if you haven't taken advantage of pulling those leads out of your lending partners, sit down with them and say, look, if you come across somebody that has a down payment, but they can't qualify right now, I'll go get them a home and then you can refinance them. So you'll still make the money. And I once had George tell me what he made off of refinancing seller finance people once. It was a pretty high number. So they should be happy to do that, because if you wait, they probably won't use you as an agent, because everyone seems to have a relative now that does real estate, and they probably won't use that lender, but it's a way of locking them in now and getting you your commission now. The second one, which right now it seems like short sales would never happen. Well, guess what? In 2006, it seemed like short sales would never happen. In fact, in late 2008, 2009, I was teaching classes on short sales. They hadn't arrived really in Utah yet, but I had some attorney friends on the coast where they were doing them in Florida and California that had gone through it with me, and I wanted people to be ready here. I had multiple brokers, I mean, licensed brokers, call me and say short sales were illegal and no bank would ever do them. I would love, because I think they still deserve to eat some crow on that, to tell you who they are, but I'm going to let that go. But short sales are great because you can take the person that's not making their mortgage payment, that has to sell on a short sale. Here's why it could happen again. Right now, the estimates are we're 33% over market based on the average Utah income, which means in a normal world, prices would be down from what they are currently. And so you've got hyper prices, you've got a stock market bubble, you've got real estate bubbles in different parts of the country. If rates went up to 4%, what do you think would happen to real estate here? I'll let you answer that in your own minds. But let's say it was not something the government controlled. Let's say it's like the 80s where it's market driven, and in order to sell their T-bills, they have to put rates up to 11 or 12%. I think you can imagine what would happen with real estate and values. And now people are having to do short sales. Well, you can go to those people and say, list your short sale with me. We'll save the money that you're not paying the bank. And then we'll use that as a down payment on another property that you can actually afford. Do you think the short sale teams that worked with us and used seller finance did very well when short sales were in vogue? They did, because they were able to answer the seller's biggest question. Why should I list with you? You're just going to take a commission and kick me out in the street. They were able to say, no, I can help you to get into another property. KSL and Craigslist are actually really good. Sellers that you can list, and again, you don't put the property address. You're going to put, 4-bedroom, 3-bath house in Sandy, this price, and the agents that do a lot of this, they've learned that getting people to call is the big thing, right? So they'll put in something that people don't really know about, and so I'll give you some of the language that they use, and that is, I specialize in non-bank financing contract for deed. And so by doing that, they get calls not just from buyers, but from other sellers and even other agents. Well, this agent had one listed just like that on KSL. In fact, he made a trophy of this property address and put it in his office. And I'll tell you why as we go on. But a seller called him who had had a high-end property on the market for over a year and had not been able to sell it. And he explained to the seller what it was and how it worked. And the seller said, I'd really like to do that. And at that point, the seller disclosed that they had it listed with another agent. He said, I'm sorry, if you have it listed, I can't help you. Maybe you could talk to your agent. So the seller she went and talked to her agent, and the agent said, oh, that's okay, he can have it. I don't do seller financing, which I thought was a strange answer, but okay, you know, maybe she thought it's been on there a year, he'll never sell it either. So I love to ask in a live class how long people think it took to sell that property. Again, it'd been on the market over a year. Add to that, he came in and raised the price, which seems crazy. If it didn't sell at, you know, at this price, why would I sell at a higher price? And, you know, I'll get guesses a few months, maybe a couple weeks. It took him 8 days. The offer they accepted was $300,000 down. The backup offer was $150,000 down. And so we closed on a contract for deed sale with $300,000 down. Usually that would be the end of the story. Unfortunately, the buyer had his wife kick him out of the property and move in her boyfriend. So he, for some reason, wasn't happy with that and stopped making the payment. And the seller forfeited that buyer out, took the property back, and sold it to the $150,000 backup offer. So this was a large commission. On the first one, the listing agent, who again got the listing because they'd put something in KSL, I specialize in non-bank financing contract for deed, he got both sides of that transaction. And he also picked up the buyer's listing in Park City, which was a $2 million listing, because the buyer was pretty excited about that seller financing format. He took the seller when bought a smaller, albeit still very expensive property for her, and then again closed a second time, but he only got half a commission, poor guy, when it resold at the $150,000 backup offer. But I would suggest people are looking for this. So if you can find those people, even in this climate, most of the properties I bought as an investor last year, I had them leave their loan in place. I had them use seller financing. All right, other agents are great. The agent I have that closes almost the most of these won't let us teach this class to his other agents, because anytime the office gets something that's a little weird and it might be seller finance, they just give half a commission to him to close the transaction. Past clients, I would use your sphere of influence. I think you'd be surprised how many people know somebody that might use this. Here's one we're seeing a lot right now. Rich parents have kids, but they're a little concerned about the spouse, but they want to help them get into a house. So if they just give the kids money to buy the property, that may not be the best option if that suspect, you know, in-law, brother or daughter or sister-in-law ends up going haywire. So what they're doing is they're buying the property and then they're selling it to the kids on contract. And because it's a contract, you can put in a number of things to protect against that scenario. So we're seeing a lot of that, especially when kids go to college, they'll do something like that. Investors are a great one. Now I mentioned the system a lot of investors are using. In fact, I know an investor that's making over $40,000 a month, just matching up people that are going and buying the properties on an investment loan and matching up seller finance buyers that have selected that property to live in. So those can be very good as well. Large corporations, you know, we have a little bit of time, so I'll tell you, and this is just to get your ideas flowing, right? This isn't the do-all end-all list, but we had somebody that had an in at UDOT, and if you know, people think UDOT's government, well, it's also a large corporation. What UDOT was doing is they were kicking out people on the West Corridor, and those people couldn't go buy a home. And UDOT's problem was when they kick someone out and they can go buy a home, it's a mathematical equation. When they kick somebody out and they can't go buy a home, it's a lawsuit and an emotional equation. Let me explain how that works in a courtroom. You're my jury, and here's my argument. Ladies and gentlemen of the jury, think about the home you live in right now, the one you're going to go home to, you're going to hug your kids, you're going to scratch your dog's head. Imagine if a government entity came to you and said, we're kicking you out and you can't buy another house. You get to go rent. Is the value of your current home just what they're saying the value of the property is, or is it much more? Would you not pay much more to own another house again? wouldn't you want more than just a little bit of equity and go rent? That's exactly what I'm asking for. I'm asking you to compensate my clients for their loss, not just the dollar amount, but what it would mean to you if a government agency kicked you out in the street and you couldn't buy a home. You hopefully you felt that, right? You felt that it goes from 50 to 150,000 or more, right? And so he had heard, it was his sister that worked at UDOT. She was the secretary of one of the big wigs that was complaining about this. And he said, hey, maybe I could solve their problem. And he did. And we closed person after person after person. And the smallest check he had to work with was $74,000. Now, even in this market, you could find a property. In fact, if you have a client with $74,000, talk to one of us, because we'll sell a property with $74,000 down, no problem. But large corporations, you have all these companies that are coming to Utah, right? We just hit on the index #1. We took over San Francisco. 2 of the top 5 municipalities on the list are in the Wasatch Front. You have Provo, which is #1 because of Silicon Slopes, and you have Salt Lake City, which is #5 now. But be aware, they're bringing people in that want to buy a house and they've got money, but maybe they've got a house in California that because property values in that area are going down, they can't sell or don't want to sell. So tap into those because those are huge resources for multiple closings. Business owners is another one. Now, I know none of you are self-employed or have had to try to get a loan. Okay, I saw one person smile on that, on the list. Oh, I've got one thumbs up though from Jesse. Nice job, Jesse. But self-employed people, it really is a pain to get a loan. It's actually easy for them to understand seller financing because they're used to contracts. They're usually business owners. So don't leave a business without making sure that business owner knows you can help them buy investment properties. You can help them buy primary residence. You can help them sell the big house and downsize and still make money from those assets as they sell. Listings, we went over, how using your listings to put in KSL and Craigslist can be a great tool to get buyers. And the last thing is, on the studies they've done on this, each person that does this knows 7 people in a similar circumstance. So ask for those referrals. And I'm hoping that that was helpful to you, that it wasn't wasted time. Because if you take this information and all you do is open your mouth, all you do is people you're closing with normally, you tell them, oh, and by the way, here's my other skill set. If you know somebody that wants to buy or sell, wants to sell their home but still get an income after they sell, or they want to buy and can't qualify for a loan or don't want to deal with the bank, I'm the expert, meaning you. Please do that. And I promise you will have some results, especially as the market changes. So most of you will start with buyers. If you're going to work with buyers, have a lender that can fix their credit, right? I can't tell you who that is because we don't advertise during these things, but we know some people that can assist you with that. Buyers will usually lead to listings. I have some agents I work with that specialize in calling for sale by owners and expired listings. And what they've done is they've gone and got a buyer pool, because then when they call the seller finance or the for sale by owner or the expired listing, instead of saying, hey, I'm just better than your last agent, and then they're pissed off because the last agent was their spouse, he's saying, I have buyers already that would love to buy your home. Let me tell you about them. One of them has $40,000 down. One of them has $60,000 down. One of them is just selling their house in California, and then they can actually pay your house off. Can we talk? And that is a phenomenal tool. No matter how you're getting your listings right now, which, let's face it, those are tough to get. That is an added tool you can use. But your listings will often become new buyers for you, and sometimes new seller finance buyers. The last thing I would say in the system that you need to focus on is, please be aware of the final closing. You do not want to put somebody in a 2-year seller financing where they just filed bankruptcy and had a foreclosure, and there's no way on this green earth they're going to get a loan in 2 years. You want to make sure the term is long enough for them to be able to finance the property. So make sure that you have that final close in mind so that it's a successful transaction. And to do that, you're going to usually need a lending partner that understands those guidelines and timelines. The other thing I would say is this. You put the transaction together, you sold the property, you're done, right? You've earned your commission, you've received your commission. Who has not been paid? Out of everyone that's worked on this screen, right? The title company's been paid, listing agents paid, buyer's agents paid. The lender hasn't earned a dime yet. So the lender has the most reason to track that to the end, to work with those buyers, make sure that they're going to complete their contract. So that's why I would say work with the lender that can track those buyers for you. Honestly, I'd say that can herd those cats for you, because if you tried to keep track of buyers after you close, it can be interesting sometimes. So in closing, there are 3 types of people that are sitting here watching this, maybe 4 on this one. The 4th one I'm not going to mention too in depth, because they're the ones that, like, they've totally tuned out, and like just to the right of their screen is Tom and Jerry just rocking away on YouTube. But for the 3 that usually pay attention, we have those that don't get it and do it. Now, if you're one of these people, right? If you're like Raquel and you don't get it, you're like, contract for what? All inclusive who? But you start talking and you start including it in your advertising, you'll do very well, right? I mean, she more than doubled the amount of closings that she was doing. If you get it, if you understood what was being taught and you add it now, you're going to be successful now. There's a reason why those that do it prefer it to normal transactions. But as the market changes, right? If we wake up tomorrow and US is no longer the reserve currency, or the stock market's crashed, or I don't know if you've noticed, mortgage rates have been going up. Just one direction right now, because the world is a little nervous about buying US government debt. That's not that the government isn't still doing all they can to keep them low, but the government ultimately doesn't decide the interest rates. They can influence them. But if rates go up, you're going to see a huge change in our market. And if you've already incorporated this into what you're doing, it is a great balance, right? I don't know if you know the statistics, but the agents that were licensed at the start of the Great Recession in Utah, less than half were still licensed in 2010. Less than half. Don't let that be you. So you'll be very successful if you just add this to what you're already doing. And then you have those that just don't do it, right? When we have the class here, we have a big lunch for them. And the second they see lunch, it's like they took a big whiteout squeegee and went whoop right out of their brain. Please don't let that be you. You're going to find that when the next correction comes, the people that get out ahead of this are going to do very well. And those that know about it, they'll catch up. But those that just don't do it, and what's funny is we actually taught this class before it was CE, and I taught it before the Great Recession. And so I put this in way back then. I said, learn the script. Would you like fries with that? You know, or it could be welcome to Walmart or whatever. And it hit me like a ton of bricks once when I went through a drive-through in early 2011 and an agent I knew was working there. That just floored me. I'm like, I have failed. If I've got agents that don't understand how to thrive in a difficult market, that's on me. And so please don't be one of those people. I am now going to open it up a little bit as well for some questions, but I'm going to put up the contact information. George, if you could again in the comments put up your
You bet.
email and phone number, but please write these down somewhere. In fact, don't write them down. Pick up your cell phone and put it in your contacts, right? And whatever, like, I don't know about you, but I've got hundreds of names in my phone where it's like Jorge Drywall, John Plumbing, right? I don't know their last name. I just know what they do. So go ahead and put, the names in seller financing lender or seller financing title or seller financing. Dave will actually walk people through these from an agent side if need be. But I do want to touch on a couple of questions that were asked earlier. We talked about the due on sale clause, and right now the due on sale clause, I will agree, is not a risk. But if rates went up to 12%, you better believe banks are going to try to get rid of their low interest loans. And so if title is transferred, they're going to see that on the tax return or the tax notice from the county. So if you have a seller that's really worried about the due on sale, we can talk to them. You can talk to them about maybe using a contract sale instead, where that limits that liability. Another question that was asked was regarding, I think, which transaction is the best. It really just depends on the circumstances. It depends on how much strength the buyer and seller have. If it's a really strong buyer with a huge down payment, it's probably going to be an all-inclusive. If they've only got 10, 15% down, probably a contract sale. Less than that, probably it's going to be a lease or a lease option. So let's open it up to other questions. I mean, this is your free legal advice time. Oh, I do have one. Would you like to hear about the golden email? Just nod your head if you would, because this will save you from lawsuits and division issues. Okay, so we've got some yeses. The golden email is this. We deal in a litigious population in something that is usually people's biggest asset. So we need to take care of ourselves. So I would tell you this, and if you want to write it down, great. If it benefits you, get it or send it with an acknowledgement in writing. So I'll repeat that again. If it benefits you, get it or send it in writing. If it benefits the other party, make a phone call. Because I promise you, anything you write, I can take and really make it mean something you didn't mean to make it mean. And one of the things I see this in is when people buy properties that you really think they shouldn't, send an email to them saying, dear Mr. and Mrs. Stupid, or substitute their name. I understand that you've skipped over the home inspection and you don't want a home warranty because you're really good at Legos. That's what you said. But I said, in my opinion, if it was me, I would do those things. Can you please confirm that you're deciding not to do that of your own accord, even though I have suggested it might be a good idea? Because then 2 months later, when they're sitting in the house with the leaky roof and the electrical shot and it's freezing, they get what's called selective memory disorder. And it goes from the initial conversation of, we should have followed our agent's advice, to, I wish our agent would have made us do it, to, I think I remember you telling the agent you wouldn't close without an inspection and an architectural study and someone looking at the roof, and they told you not to worry about it. And if there were any problems, they'd take care of it. And that's what they tell the division, and that's what they tell their attorney. So the golden email is a good thing to keep in mind. Let's open it up to any other questions.
Checks.
Yes.
I have a quick question, silly, but question. What is it typically cost for seller financing expenses by attorney and the escrow companies and the lender?
So that is a great question. So first of all, the lender cost is zero because they're not doing a loan at that point.
Okay.
I can't speak for all title companies, just the one I'm aware of. The buyer's cost, the total cost for the buyer is typically less than $500. Same thing for the seller, but the seller will provide an owner's policy. So that'll be based on the sales price. And then the buyer will depend on if they're providing a lender's policy or not. But if the buyer is not providing a lender's policy, they're typically less than $500 plus their down as far as title costs. And we don't charge an additional legal fee on those. It's all just pretty typical closing fees, but that is an excellent question. Now the agents, I will see sometimes agents who have this expertise, they'll charge more than just a 6% commission. In fact, one of the gentlemen that does this quite often, he listed another agent's property. The agent was licensed, active, but he couldn't sell his property for the price he wanted. This agent went in and sold it for an increased price. He got him 10% more than he was asking for, but he asked for 1% of that back. So his commission was 7% instead of 6%. So as an agent, you can use this expertise possibly to get more, but the title costs are going to be a lot less, well, closing costs, because there's no loan costs, are going to be quite less than normal. They won't have the loan costs until they refinance it. And at that point, they'd encounter those. Excellent question. I like that. Did I answer your question sufficiently, Jesse?
Yes, thank you, Jax.
You bet. Any other questions?
Jax, Brandon
Jax,
Stanger.
I have, oh, go ahead. I'll wait.
I've done a few where I'll actually put into the contract that we're going to do an appraisal upon the exercising of the option. Is that okay? Or do people ever do that?
That is a great thing, actually. In fact, when we were doing these just after the crash, like the first 2 or 3 years, a lot of buyers were worried, and sellers, frankly, that the property values might go down, which sometimes they did. So I would give them one of my clauses, which was, in the event the property does not appraise for a value sufficient for the buyers to pay off the contract, seller shall extend the contract automatically for a period of 7 months. The sellers liked it because they don't want to take a property back and have to sell it for a lower price than they're already owed. The buyers liked it because it allowed them time if the appraisal was the only issue with them getting a refinance of that contract. So yes, that's a brilliant thing, Brandon. I mean, if you've got one of those Burger King gold helmet things that, or a star, put it on, because that was a great suggestion.
Thank you.
Deborah, you had a comment.
Yes, I have actually a couple questions. First, with the indemnity, is there a standard form that we should be using for that in the Utah real estate forms, or is that something we'd need to get from our brokerage to present to our clients on this?
So the answer is partially. There is something that, in your normal intake forms, and especially a lot of the brokers I've worked with, we've worked on doing some additional forms. But your normal forms from the MLS will have some things that say you're not their attorney, you're not giving them legal advice, you're not giving them tax advice. It'll have them say that they choose or not to get a home inspection, and it's on them for that. But on every one of these closings that I do, I've got an indemnification form I use, and I don't put that form out because it's one of the advantages I think I've got. It started out as 5 pages. I did get it down to 2. But if you have a specific concern about a closing, it is a good idea to talk with your broker about maybe some additional indemnifications with the client, acknowledgments and indemnifications to protect you, because you're absolutely right. The time to do that is before the closing, because after the closing, when they're making threats, they're probably not going to sign something like that for you. Did that answer your question sufficiently?
Yes, it does. I have one other question.
Yes.
I've run into a situation recently where a seller was planning to sell their home at market value to a family member.
What could go wrong?
What could go wrong exactly? They decided as they started interacting with the lender, it was a grandmother selling to a grandson. Okay. And they started talking to the lender and looking at different options.
Can I just, sorry, just real quickly. Some people are asking if they can leave the class. Sorry, that's my job. Yeah, sure. The class is over with. If you want to stay and ask questions, that's great, but the class is technically over. I put a link in the chat that you will need to, will take you to the Google form. So
would you do me a favor as well? Would you please in the chat, if you did like what we presented, would you please just say it was good? Or if you thought, hey, you really need to go focus more on this, please put that in as well. We'd love that feedback. Usually we get the forms back, but we do value your feedback. Sorry, Leslie Ann, please continue.
Yeah, you're fine. And I'll leave this open for people to chat, but it's excellent. Just a lot of information to take in. It was recorded and it will be, I think, available on YouTube under Presidio Real Estate. I think for myself, I want to watch it again and maybe again, just to